Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading in France-L'Aqua in London with Tom McKenzie.
And here are your top stories. Market mayhem. The S&P 500 drops to a 22-month low as the Fed's Loretta Mester says a US recession will not stop Fed hikes. Popularity contest, the UK's Labour Party surges to the biggest poll lead over the Tories in over 2 decades in the wake of Liz Truss's mini-budget. Plus, crisis talks, EU energy ministers are set to approve emergency intervention, but a deal on a gas cap remains elusive.
What a week. Happy Friday. We've made it to Friday, Tom, which is actually no small feat when you look at the volatility and actually some of the wild swings that we've seen. Look, the pound now back to the level pre-quasi-quartile mini-budget last Friday. DAX futures gaining 0.7%. FTSE 100 futures flat.
We flagged what Loretta Mester had to say of the Fed. James Bullard also saying that finally the markets are getting it. They're not going to escape higher rates without a little bit more pain. And I'm paraphrasing, but that was essentially the message from that Fed official. The FTSE 100 currently down 0.1%. We have the CPI out of France coming in slightly lower than the estimate, 6.2% for the month of September. The estimates have been around 6.6%. We had slightly softer inflation out of Spain yesterday, but the inflation print out of Germany was distinct, around 10%, so very high inflation out of Germany, even as it starts to soften in France and Spain. The CAC currently gaining 0.6%. Over in Spain, gains of 51 points, up 0.7%, as we await more details on those energy plans from ministers in Brussels. Let's switch it over, look ahead to what's happening stateside, as the tech sector was once again in focus, with Apple facing a pretty rare downgrade, and that stock falling around 6%. That dragged the Nasdaq lower. It ended lower by around 3%, close to 3% at the close. The S&P 500 around 2% low. As we said in the headlines, a 22-month low now for US stocks. But futures are pointing up by 0.5% stateside. The dollar has come off a little bit. 111 is what you're getting on the pound, and of course the dollar plays into that. So yes, getting back, as Francine said, to the levels that we got before quasi-quartile, the Chancellor's mini-budget, currently gaining 0.2% at a 111. The 10-year is at 3.72. Not a lot of movement there, and Brent at $88 a barrel, a gain of 0.1%, Francine.
I would say it's a funny old day. I know it's not CFA level 4, but it's a bit of a funny old day because it's also positioning for the end of the month. So there's a little bit of quirks out there when you look at the markets. Now, what I'm seeing up and out of the 19 groups, Tom, that make up the Stock 600, actually all of them are up. And then if you look at some of the staples, so here and there are pockets of indecision where you see a bit of pressure. But energy, construction, insurance on the way up the most. And then I have technology, retail, gaining some 0.1% on technology. I find it amazing. Meta for the first time actually saying, guys, we're going to pare down. We're not going to grow as much, and they're actually cutting jobs. So something definitely to keep an eye on for the whole tech space in general, Tom.
Yeah, to what extent are the woes of Meta a canary in the coal mine, as you say, for the broader tech sector? Now, unprecedented daily swings in the US interest rate swaps market are flashing warning signs that liquidity is draining from the world's financial system. Former Treasury Secretary Lawrence Summers, otherwise known as Larry, likened the array of risks confronting the global economy to the pre-crisis summer of 2007, with UK's current troubles just one example of potential breakdowns.
Now we're joined by currency and rate strategist from our MLive team, Venram, and Willem Sells, Global Chief Investment Officer at HSBC Private Bank. Thank you both for joining us. Happy Friday. Willem, I don't know how painful your week was, but it does seem on the UK that things are stabilizing a little bit. Will they stay stable for long?
Well, it's certainly been a busy week because everybody is obviously looking at what we should be doing here. 108 was our forecast for sterling. Even before the mini budget. So we do think that the UK remains vulnerable. We just heard from the ONS that we are the only country here in the G7 that is not yet bigger than before COVID hit. We are it is a slow growth environment. And then now, obviously, with the rising budget deficit and the rising interest rates, that is going to have a toll on investment spending on the housing market. I think markets generally, currency markets, equity markets, are more and more turning their attention on the damage that those interest rates are going to do to growth. So that's why we are defensively positioned on the sector basis.
Okay, defensively positioned in this environment. Venram, let's bring you in at this point. The warning then, Ven, from Larry Summers, that this is starting to look like there are echoes of 2007 in these markets. Does that align with what you're seeing, Ven?
Morning, Tom. It certainly aligns and squares with what I'm hearing from the markets. You've got so much of leverage that needs to be unwound from the pension funds investing in the UK via the swaps to hedge their gilt positions. Now that all that leverage needs to be unwound, and it needs to be orderly. And there are the BOE's backstop has helped, but this is already making its presence felt everywhere else. For instance, in the US. Investors are parking the highest level of record amounts of money with the Fed. So they're scrambling to safety, and how this is all going to play out, how the damage is going to be put back into the bottle, so to speak, is hard to reconcile at this point, because we've got until October 14th when the Bank of England is going to backstop long-dated bonds, but what happens after that? So it does look like either there's got to be some kind of measure from the fiscal side or the monetary side before October 14th. And until then, it's going to be an uneasy period of calm.
Yeah, an uneasy period of calm. I mean, at least there's maybe relatively calm, or you're calling calm, others aren't. Willem, where do you see the most vulnerable, actually, in UK markets? I know there's talk about, zombie companies are also companies going under, especially you look at the smaller ones on the FTSE 250.
Yeah, I would say that we're probably not in a 2007, 2008 scenario. Certainly on a global environment, when I look at the default rates, the delinquencies, and so on, especially in the US, are very low. I think the households as well, are sitting on decent savings in the US, and also the ONS said today as well that even the UK households are sitting on some savings. Now, of course, there is a whole distribution, of the population here. And there are households that are much more vulnerable. So we would, look at clearly within the UK market, at those larger companies, the global companies relative to the FTSE 250. They are more diversified, they're less dependent on the UK economy, and they're also more benefiting from the sterling weakness.
And Willem, where are you finding earnings resilience in this environment?
Yeah, so it's it's companies that are able to pass through their their cost increases to the customers. So those are quality stocks. Quality for us is actually earnings resilience, but also low leverage, obviously, in this environment with rising rates. You are starting to see, obviously, even though inflation continues to remain high, there are areas where inflation is falling, in particular in the goods space and in the transportation. So we are seeing some signs of companies actually benefiting from that on their cost side, and not yet cutting their prices, for their customers. So actually, they are able to protect those margins. So look at the goods space, look at the consumer staples, not at the consumer discretionary, because there you're obviously more dependent on the the buying power of the consumer.
Willem, is there something that actually could change very quickly? So for the moment, some of these retailers have been able to pass increases. How do you differentiate, for example, within the subsectors of retail?
Yeah, so the luxury goods space is doing reasonably well and is resilient, as you can imagine. Those households that are buying in the luxury goods space, they have the better savings and the incomes as well, and spend less of their disposable income on the basics. The areas where we see more weakness are those that are obviously related to the housing market. So those are white goods and so on, which are doing quite poorly, and we are seeing house prices decline, housing activity decline as well. So that's an area of weakness. Autos is also an area of weakness in part because obviously it's a high ticket item, and oil prices are still reasonably high, but also because of some supply chain interruptions.
Okay, differentiation within the retail and consumer space. Thank you, Willem Searles, Global CIO at HSBC Private Bank, who stays with us. We'll get more of Willem's analysis in the next couple of minutes, and of course, Sven Ram as well from our M Live team. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. Meta has outlined sweeping plans to reorganize teams and reduce headcount for the first time. CEO Mark Zuckerberg says he's freezing hiring and restructuring some units to trim expenses and realign priorities. He also said Meta will likely be smaller in 2023 than it was this year. It's the company's first major budget cut since Facebook was founded in 2004. Canada's National Housing Agency is set to revise its forecast, saying house prices will drop as much as 15% by the middle of 2023 from levels seen earlier this year. It says higher mortgage rates threaten to cause a protracted slump in real estate. Its July forecast was for a 5% slide. SoftBank Group is said to have started laying off employees at its loss-making Vision Fund. Bloomberg's learned that it's expected to cut at least 30% of staff from the London-based unit, which has about 500 employees. The Vision Fund recently posted a $23 billion loss, with most of that coming from a plunge in valuations for its portfolio companies. And Amazon is to close all but one of its US call centers and shift hundreds of office employees to remote work in an effort to save on real estate. The e-commerce giant has been seeking to reduce expenses as sales growth slows amid rising inflation and economic uncertainty. That's your Bloomberg Business Flash. Tom, Francine.
Alice, thanks so much. Alice Atkins in London. Coming up, EU energy ministers are meeting today on the agenda, energy security and a cap on gas prices. That's coming up next, and this is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
You have to be able to give our customers' vehicles, that are their primary vehicles that are EVs. And to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
Welcome back to the Open, everyone. 12 minutes into the European trading day. It's a Friday. A lot of the focus, of course, will be on the UK after the week that was. A lot of the focus is also on what we heard from the Fed. The message is, even if there's a recession, we're going to focus on inflation. Markets certainly in Europe, but taking their stride for now. European stocks getting some 0.7%. But again, it's also pretty volatile as we race towards the end of the month.
Yeah, and we switch focus to energy now. And EU energy ministers gather in Brussels today as the bloc fights to come up with joint measures to tackle the ongoing energy crisis that risks upending European economies. On the agenda is energy security and a potential cap on gas prices. This after the damage to the Nord Stream pipelines, what NATO calls an act of sabotage. Joining us from Brussels is Maria Tadeo. Maria, what is the outlook then for energy ministers? How much wrangling is going on behind the scenes? How much does the price relief actually materially help?
Yes, there's a lot of it behind the scenes, and the meeting now started, of course, is in full swing here, and we heard just a few moments ago from the Energy Commissioner, Kadri Simpson, who repeated, in her view, there needs to be a Russian cap on gas immediately. She also said something quite interesting. We talk about a cap, a full-on on Russian supplies, but she mentioned with countries that we can negotiate, with partners and friends, we should enter a negotiation to bring down prices immediately. The issue here is that that's her view, that's the proposal put forward by the commissioner, but this is Europe and you need everyone to agree on this. And behind the scenes, there's tension in the ways that we should go about this. And there is no consensus for the time being, or at least that's what I'm being told, for any cap whatsoever to come out of this meeting. The other interesting thing is the response to the mega package that was announced yesterday by Germany. That's also creating tensions behind the scenes. Some countries suggesting that this is Germany going at it alone, and in some ways it's the opposite of the solidarity message that the European Union wants to send, that they're acting as one.
Are they acting as one? I think it's probably the million-dollar question, right? Is Vladimir Putin in the winter going to get his way?
Yeah, and that is a big question. Is he going to get in the way on the energy war and the supply war? But also, Francine, now the infrastructure, there's a real concern here, and it's floating in the air. You can really feel it after the explosions, the leakage that happened around the Nord Stream 1 and Nord Stream 2, whether this could now get physical. And you do have a number of countries that say we need to step up the protection of our infrastructure. And by the way, the Commission also saying any damage to European infrastructure will be responded with the strongest terms. And today, by the way, NATO just announced at 6 p.m. a press conference. Remember, yesterday they said this was potentially severe escalation, the mystery around this explosion, the leakage, who did it, and whether or not there was real sabotage intended behind it.
Maria, thank you so much. Our Maria today there with the very latest, of course, on this important meeting in Brussels. Now, let's unpack some of this with William Sells, Global Chief Investment Officer at HSBC Private Bank. Willem, I don't know whether the worst-case scenario for energy to Europe has now been priced in.
We don't think so. I mean, it's impossible, obviously, to know what will happen, but there are tail risks that, we don't think are priced into the European markets, whether it be the equity markets in terms of price earnings differentials, also the earnings growth, or even in the euro as well. So that's why we continue to have, a very large underweight on European stocks, Eurozone stocks compared to the US. It's both an index return target, but also, a currency element, of course, which is what you've seen across markets, right? The FX element is a very important, input into the returns.
Willem, on FX and the question of the pound, something of a floor, it seems, being put under the currency, at least for today, getting back to those levels pre-mini budget. And the market's pricing in around 140 basis points by the BOE by November. Will that be enough to turn things around? What, and if not, what will?
Well, it's a lot in terms of interest rate hikes that is priced in, and of course the market is reacting to the yield spike, and then the Bank of England's intervention. The Bank of England's intervention basically stabilizes markets to some extent, or at least makes sure that they can function. But obviously, the level where those yields stabilizes and the level where therefore sterling stabilizes is going to be more a function of where the market thinks that foreign buyers and local buyers are going to buy that debt. And that's a function of growth. That's a function of whether we get any spending cuts, obviously also any further measures or backtracking on measures that have been announced. Those are all lots of variables. As I said before, I think the biggest variable on all of this is the growth rate. The UK is doing worse than others. We are not in a recession in the second quarter, but we're probably in one in the third quarter. And that continues to weigh obviously on the sustainability of the debt, and that's what people are concerned about in the bond markets. In the FX market, it's much more the growth element.
Yeah, but Willem, when you look at actually FX, when do we see a bit of stability? Like, what do we need to work our way through for dollar, for example, to stop rising?
Yeah, so I think it's, what you mentioned, I think, the uncomfortable waiting game, which markets are going through, that's across markets, whether it's equities or bonds or, FX, and it's this uncomfortable waiting game for core CPI to stabilize. Now, we talked about, goods price inflation coming down, but it's really this, services price inflation that continues to be extremely sticky and actually rise still in most markets around the world, and that's linked to the labor markets. So that's the one to watch. Labor markets and consumption. The issue there is obviously that labor markets are a lagging indicator, and that consumption, is somewhat supported by, those savings that we've had, during the COVID period. So people are actually quite pessimistic. You're going to have the Michigan Consumer Survey, soon, which has actually been relatively weak. Survey data is weak, confidence is weak, but spending continues to hold up. Central banks want to see a deterioration in that spending growth, a deterioration in the labor market, or at least a topping out of that. That can then stabilize CPI, that can stabilize interest rate movements, and therefore then the dollar as well.
Okay, let's link that, Willem, to what's happening in investment-grade credit, because I know you favour being exposed to some extent to investment grade. If the Fed is going to have to work that much harder, because the labour market, as you say, the data is suggesting it remains very tight. If the Fed has to work that much harder, then there's a risk of a blowout of spreads, that leverage is high, recession risks increase. What then is the case for investment grade?
Yeah, within investment grade, obviously we prefer investment grade over high yield, number one. Within investment grade, we're also short, in terms of duration, and that's where, people can pick up some income, in part because income obviously is a very important element of returns in a portfolio, especially as, the cycle challenges the earnings, results and so on. It's income from investment grade, it's income from structured products, and it's income from, dividend stocks, at least, those companies that can continue to pay it out. And so those levels have achieved, levels that are more attractive in portfolios. But indeed, continue to be selective and keeping duration short there. Even floating rate notes as well, where people are sitting on a lot of cash because they think those interest rate hikes continue to go even higher. There is some interest from our clients in floating rate notes as well. Again, short duration.
Okay, short duration, be picky, making the case there for investment grade and consumer staples as well, staying defensive. Willem Selves, Global CIO at HSBC Private Bank. Thank you very much. Have a wonderful weekend. Coming up, Meta, the Facebook parent company, of course, is freezing hiring and restructuring some departments. We'll get the details next. This is Bloomberg.
let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
Welcome back to the Open. We are 24 minutes into the European trading day. Happy Friday. The dollar is down. Bonds are bid, at least for now. And equities are, in fact, higher. Across the benchmark, you're seeing gains of 1%. Futures in the US are also up by between 0.7 and 0.9% after the battering that they received yesterday. Let's check in on some of the individual stocks in focus for us today. Of course, we continue to pass what's happening on the earnings front, and particularly around inventories as well. We had, and we're watching Adidas, we could watch others within this space, retail space, consumer goods space, of course, on the back of what happened with Nike overnight stateside. You're seeing the reflection now, down 4% with Adidas, because Nike came out and said that they are seeing inventories surge, and in fact, they're having to push through discounts just to get and shift that inventory. So the read across there, Adidas down 4%. ASML, of course, a major production or producer of chip-making equipment, currently gaining 1.5%. This despite the fact that Micron over in the US says it's going to be cutting its budgets for machinery and slowing down production as well on the back of weaker demand. And Cineworld gaining 3.2% on the back of first half revenues coming in at $1.5 billion. So a pretty decent gain there for a company that's working through bankruptcy proceedings, Francine.
Yeah, and then the Meta chief executive, Mark Zuckerberg, has outlined sweeping plans to reorganize teams and reduce headcount for the first time ever. When that story broke, I actually had to do a double take because I hadn't seen it before. So I was like, wait, is it really Meta, formerly known as Facebook? So it'd be the first major budget cut since Facebook was founded in 2004, marking an end of an era of rapid growth. And I wonder whether it's symptomatic of something bigger, right? Not only in tech, but like when you see Facebook, Meta doing that, you kind of wonder, right, what are we going to live through in the next couple of months?
That is the point. You said it. Since 2004, they've never cut headcount. And in this speech and in these communications between Mark Zuckerberg and his staff, he said they're going to be cutting budgets across departments, even in areas where they're trying to grow, like Meta. So consequential, is it a canary in the coal mine for the broader tech sector? You've already seen some companies cutting back. Now Meta is doing the same thing.
Coming up, the UK narrowly averts a recession for now ahead of Liz Truss's first Conservative Party conference as leader. We break down the extreme UK market moves of the past week. That's coming up next, and this is Bloomberg.
floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Well, welcome to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Market mayhem, the S&P 500 drops to a 22-month low as the Fed's Loretta Mester says a U.S. recession will not stop Fed hikes. Popularity contest, while the UK's Labour Party surges to the biggest poll lead over the Tories in over 2 decades in the wake of Liz Truss's mini-budget. Plus, crisis talks. The EU energy ministers are set to approve emergency intervention, but a deal on a gas cap remains elusive. So, Tom, we're looking at all things market, we're looking at some of the CBD stocks, and of course we look at the context of what the Fed does and what Liz Truss does next.
And for now, at least, that market mayhem headline really applies to what happened yesterday, because now you're seeing a turnaround in terms of bonds, that demand there for bonds, money flowing in, equities as well. But as we've seen, these kind of buy the dip scenarios that we see on a fairly regular basis on the back of all this volatility is usually pretty short-lived. So we'll just see how sustainable this is, again, on the back of those comments from the likes of Bullard saying markets are now starting to learn that they are going to have to suck up some pain in the face of these higher rates. So again, the benchmark here in Europe on this Friday gaining 1%. The futures in the US up as well by between 0.7 and 0.9%. The DAX over in Germany adding 129 points. The FTSE 100 up 0.6%. Worth reminding viewers that in Germany, you got that inflation print of above 10% yesterday, screeching high, even as inflation in Spain and France comes off a little bit. But it really points to the conundrum then for officials in Brussels as they work through that energy price cap. The FTSE 100, of course, we continue to focus on what's happening in the pound. It's turned around a little bit in the session today, back to those almost those pre-mini budget levels, 111 on sterling. We know that the Prime Minister and the Chancellor will be meeting with the head of the OBR to discuss their analysis, at least prelim analysis, of the fiscal spending plans of the government. We watch that as well. Let's turn over and have a look at what sectors are performing and how well they're performing. Top of the list is retail, followed by banks gaining 1.8%. Just one sector in the red, personal consumption currently down 0.2%. So that's how things are playing out across the sectors on a day when there is a move back into bonds. Yields are off, particularly at the front end here in the UK. Gilts 2 years, 4.16 down 23 basis points. The 10-year at 4.03 down 10 basis points across those benchmark gilts. Again, the BOE has stepped in with bond buying at the longer end. We'll see, though, how long this continues, Francine.
Now, the UK economy grew in the second quarter, averting a summer recession despite the cost of living crisis. The news will be welcomed by the government, which has been hit by a run on the pound and a financial crisis since the mini-budget last Friday. Now, for more on all of this, we're joined by Bloomberg's Lizzie Burden. So, Lizzie, good morning. If you look at, the data that we had is also the wider context of we had a pretty ugly week, but actually today, pound levels are to what we saw pre-budget.
Well, the pound is perhaps more to do with the fact that the Bank of England's shown that it's willing to step in. This second quarter GDP figure, yes, it's welcome news, but what we're expecting is in the third quarter for the slump to begin, because of course this is when you had the national bank holiday for the Queen's funeral. There was this somber national mood, probably weighing on sentiment. And what we also had this morning with the house price data from Nationwide, they showed there was no growth in September, first time that's happened in a year. So you're already starting to see the weight of inflation, rising interest rates. They're likely to rise even higher because of this budget. And so the recession risks remain in the longer term.
And this is really having a political cost for the Conservatives. And we saw that remarkable poll yesterday in terms of the lead that the Labour Party, opposition Labour Party, are taking versus the Tories. What is the mood when you speak to Conservative parliamentarians and MPs leading up to the Conservative Party conference next week?
Alarmed. This is the biggest poll lead for any political party in 20 years. Of course, it comes back to the budget. Kwasi Kwarteng behind the scenes is pleading with Tory MPs to get behind his plans. We're hearing that lots of them are actually calling for him to resign just to give Liz Truss the political cover to reverse the tax cuts. But it doesn't look like that's going to happen. Truss, Kwarteng and the Trade Secretary, Kemi Badenoch, came out yesterday, guns blazing, saying that these plans are going to boost the economy. And so it's a very awkward mood going into Tory conference. We'll be going, Tom. And you've got the big heavyweights of the party, some of them not even going to Birmingham, like Rishi Sunak, because he says he wants to give Truss some space.
So where does this leave, I guess, the government's resolve to continue with the tax cuts?
I mean, Truss is in a very, very awkward position because if she carries on, then she risks angering financial markets more. You've got Bank of America today saying that parity with the dollar is in sight potentially by the end of the year. If she backs out, she risks her credibility. So what she could do is cut spending. And Bloomberg Economics says that she'd have to cut spending by more than George Osborne in the austerity years if she wants to balance the books. So really politically ugly. Really interesting that she's going to meet the OBR chiefs today. I cannot underestimate how unusual this is. And we've just been having a debate on the economics desk as to how to interpret this. On the one hand, is this the government trying to weigh on the independent forecaster? Or is it actually the government cap in hand to the markets, accepting that it should have gone to the OBR in the first place if it wanted to have the credibility for its economic plans?
The former seems more in line with what we've seen from this government so far, doesn't it?
Well, remember, Mark Carney, the former Bank of England governor, said that this government is undermining the UK economic institutions. Look at how it's treated the Bank of England in the leadership campaign, and then this week it's had to rely on the BOE to come to the rescue of the pension funds.
And pretty fascinating. You mentioned Rishi Sunak. There's a lot of viral videos going around online. I'm sure you've seen them, and Francine as well, of the premonitions, or at least of Rishi Sunak. He forecast this market reaction to these policy plans, so he was spot on correct, it seems, and interviews with the FT as well going viral online from Rishi Sunak prior, of course, to losing that leadership contest. Lizzie Burton, thank you very much indeed. Looking ahead, of course, to the Tory party conference. Now, Prime Minister Liz Truss's sweeping unfunded tax cuts may end up being bad news for mortgage holders. They are already proving bad news for mortgage holders. Amid fears the Bank of England will have to hike rates faster to compensate for the looser fiscal policy. For more, we're joined by Jonathan Tice from Bloomberg Intelligence. Jonathan, how are the banks then reacting to the uncertainty?
Good morning. Well, understandably, they're pulling offers left, right and centre and hiking rates. So if you think about the way banks set mortgage prices, they use swap rates. And if you look at what the 2-year, which is a standard sort of fixed deal in the UK, swap rate was telling you at the beginning of September, it was looking at something like 4%. That's now 5.7%. So in a month, they've automatically had to reprice higher. Look at the expectations for the Bank of England moves. Again, beginning of the month, pre-mini budget, expectations were for maybe 4.5% by March of next year. That's now much closer to 5.5%. So clearly, the panic is beginning to set in, and we've released some research this morning looking at, for example, if you were a 95% loan-to-value applicant for a mortgage, HSBC would have lent to you at about 3.8% at the beginning of August. That's now 6.65%. And it's only going one way.
Wow.
It's only going one way, which means, Jonathan, that there are a lot of areas in the mortgage market that you worry about. Which one is most concerning?
Well, I think when you think about first-time buyers, you think about levelling up, and you think about kind of what the mini budget has listed as a reaction. Clearly, it's the first-time buyer space, so the higher loan-to-value space that's the issue. And if you think back to the pandemic, the government introduced a Help to Buy scheme with a government guarantee at the 95% level. Well, that's all well and good, but that expires at the end of this year. So at the moment, you've got the likes of Barclays and NatWest. They're still offering very competitive rates for 95% LTV markets, but that's only to people with this guarantee. There's a 2.5 percentage point difference between their rates and the highest non-guaranteed rates. So I suppose one area that we're looking at, yes, they've given some stamp duty relief, but what happens if they don't roll over this? It becomes very politically unacceptable. First-time buyers, the younger generation, cannot get on the housing market, and it's already hard enough because of the rally we've seen. So that's one area that we're definitely watching closely.
Yeah, I mean, those doors to younger buyers had almost closed anyway, hadn't they, Jonathan? What else, what does this mean, all of these factors in terms of house prices around the forecast for just what the direction is in the months ahead?
Well, as you just said, the growth has already stalled, and I think depending on how the banks need to react, clearly, I think you'll see that the banks revising down their expectations for next year, because house prices are a very big part of the way that they now have to figure out how much money they have to set aside for bad debt. So third quarter numbers next month, I suspect all of the banks will begin to talk about provisions, begin to talk about increased risk, lowering volume. The mortgage growth has been one of the biggest drivers of net interest income for the UK banks for 3 or 4 years. So that's a really big story for them. And I think the next sort of month or so, we're going to see people changing their tone and downside house price risk very much more discussed.
Thank you so much. As always, Jonathan Tice there from Bloomberg Intelligence. Now, coming up, German consumer inflation soars to euro highs, while French inflation unexpectedly eases. We'll break down European inflation next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 43 minutes into European trading day. For the moment, European stocks 1% higher. Now, French inflation has unexpectedly slowed, part of the diverging price picture among the continent's top economies as the European Central Bank decides whether to deliver another steep hike in interest rates. Now, we're delighted to be joined by Jana Randa, one of our star reporters, of course, in the ECB team. She breaks more news than anyone we know. First of all, Jana, good morning. How much pressure is the ECB under?
A lot, I would say. The forecast for the inflation reading this morning is 9.7%, and if you think about it, that is almost 5 times the ECB's target. So if you take policymakers at face value, with them saying we're data dependent and we need to act and we need to bring inflation back down, then the pressure is enormous. And we've seen some of that yesterday with policymakers rallying or starting to rally around another 75 basis point hike, which of course is a massive step. We've also seen Philip Lane saying, wait guys, it's much too early to settle on that. You know, a lot can happen between now and then. The next meeting is still 4 weeks out. So it's going to be a very, very interesting time the next 4 weeks to hear what they're leaning towards.
And that's really crucial. You talk about the need to convince the markets. The Fed is finally doing that, it seems, with the consistency of their communication and their messages and, of course, the rate hikes that they've been pushing through. But we know that there are disputes and that there's divergence within the ECB. So where does that leave us in terms of how we think about the next steps? Are the next 2 meetings going to be 75? Are they baked in now, locked in, 75 in the next 2 meetings? Or is it far less certain than that?
It's interesting that you speak of divergence. The way we see it is really they all agree that they need to raise interest rates. They all know that something is seriously wrong looking at inflation. The differences of opinion is in the nuance. It is about the increments of the rate increases. They're still trying to figure out where the neutral rate is. It's a fiddly concept. It's complicated. Nobody really knows. And it's of course not only about interest rates, it's also about the balance sheet, it's about quantitative tightening, when is that coming in, around the neutral rate. So there are a lot of details that need to be ironed out. Ultimately, what matters is that inflation reacts to what the ECB is doing, that inflation is coming down, and they're all on the same page on that front.
So, Jana, overall, though, and this is something that, if you're an economist, if you're the ECB, even if you're a chief executive, you need to grapple with. Inflation, for example, in France is not as high as other countries. Is this because of how their economics is composed, or is it just government intervention?
It's both, I would say. I mean, you always have different consumer baskets. You have economies getting their energy from different sources. Different import structures, different production structures. Economies are more services or more manufacturing based, and that makes a huge difference in the broader picture of things. But also fiscal measures, of course. And there was an interesting comment from the still acting Prime Minister in Italy, Mario Draghi, of course, and he said, "Look, we must not get into a situation where countries that can afford fiscal stimulus do it, and those countries that can't because debt is already high doesn't do it, and we're getting into a situation where we actually increase inequality across the bloc." So that is something that they need to pay attention to as well.
So from the uncertainty in Italy to the crisis here in the UK, what is the read across from what's happening here in the UK to the Eurozone?
I think the way I look at it is a big flashing warning sign for any European government, and probably the Italian very specifically, to basically say, look, irresponsible fiscal policy, or what the market thinks is irresponsible fiscal policy has huge consequences, and it can create market panic. It will force the hand of the central bank. We've seen in the with the Bank of England. Rate bets just went through the roof. So tightening is going to be needed even more. And we've heard some warnings from the president, from Christine Lagarde, saying governments, you need to be very prudent in what you do, because otherwise we might have to do more and you are not going to like it.
Okay. Jana Randa, comprehensive on the ECB, what is happening across the inflation picture, and the ramifications as well, the ripple effects from what is happening here, the crisis in the UK, and what it means for ECB officials and fiscal spending as well. Thank you very much indeed. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Hurricane Ian is regaining strength over the Atlantic and is set to make landfall in South Carolina later today. That's after leaving a path of destruction across central Florida, destroying homes, roads, and the power grid, and leading to unprecedented floods. Power was knocked out to more than 2.6 million homes and businesses. ABC News reports at least 9 people killed. President Biden has denounced Russia's plan to absorb occupied regions of Ukraine as a flagrant violation of sovereignty and territorial integrity. Moscow says it plans to sign what it calls treaties in Ukraine's east today. This comes after referendums on annexation condemned as illegal by the United Nations. HSBC is considering vacating its global headquarters in London's Canary Wharf when its lease expires in early 2027. According to an internal memo, the bank is aiming to create a more flexible workspace. Options include renovating the existing building or moving to new premises in the British capital. The company says it's not planning to leave London. China is allowing some cities to lower their mortgage rates for first-time home purchases. It's the latest bid to help stimulate a struggling housing market. The cities will be allowed to lower or remove the minimum interest rate until the end of the year. And a full Tyrannosaurus Rex skeleton is to be auctioned in Hong Kong in November and may fetch up to $25 million. The fossil, named Shen, was unearthed in Montana and is around 66 million years old. If you're wondering if you've got the space, Shen is about 13 meters long and weighs in at 1.4 tons. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thanks so much. It's a nightmare. I mean, the 8-year-old somehow got hold of a piece of news. He's dinosaur obsessed. He got hold of the piece of news that it's going up for sale, and he asked us whether we can buy it.
I can see this in your cavernous front room, Francine.
Yeah.
I can see it there for the boys. They'd love it.
Crowdfunding. What should we call my crowdfunding? Like, help Fran out, buy her a dinosaur?
Dino funding.
There you go.
Dino dollars.
Dino dollars before austerity hits. Coming up, it's been a dramatic week in markets. We'll unpack the first hour of today's European moves. That's coming up next, and this is Bloomberg.
When business news breaks.
The IMF calling out the UK on fiscal policy.
A shot across the bow to the whole Liz Truss administration.
The Bank of England acted amid concerns a Wednesday cash call would trigger gilt crash. John, I've never seen that headline in my life.
Trust Bloomberg for the fastest coverage and instant expert analysis.
They're doing it to try and stabilize the market, but they're having very little effect.
The term is kind of quantitative conundrum.
We are now in chaos. For continuing coverage, keep it tuned to Bloomberg Television and Radio.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Have
to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
Welcome back to the Open, everyone. 53 minutes into the European trading day. We saw a pretty ugly session, U.S. For the moment, European stocks stabilizing, gaining some 1%, Tom.
Okay, we are nearly 1 hour, of course, into the final day of action in what has been a dramatic week for the markets. We saw historic moves in UK gilts, of course, and a run on the pound that brought it close to parity with the dollar. That's turned around in the session today. A sell-off that led to central bank intervention, worries for investors, and mortgage offers being rescinded at a rapid pace. Joining us now to unpack how the first hour of action has gone down is Jan Patrick Barnett. JP, we are the last leg of a very unusual third quarter. What's kind of really stood out for you as you've monitored and watched these market moves?
Well, I got two things prepared, but I have to say the dinosaur takes it all away. I want one now as well. But more seriously on the market. So two things here. Like, unless we get a monster rally today, we will see in Europe and in the US the third consecutive quarter in the red. That's the first time this is happening since the end of the global financial crisis in 2009, where the market dropped for 6 consecutive quarters. And the other one, which is even more stunning to me and highlights how dramatic or what a turnaround this quarter was. Remember, the S&P 500 was up 14% halfway through the quarter and is now in the red. This has never, ever happened before in the history of the S&P 500 since the 1920s. Whenever there was a big quarter, a big bounce in the quarter, the market stayed up. This is the first time it's turning out to be red at the end, and this is highly unusual and shows you like how short-lived this rally was and how much pressure there is still on risk assets.
So, JP, earnings season coming up, of course, to kick off the fourth quarter. What are we watching in there? Is it cost cuts? Is it margins?
Well, it's both, I would say, and I'm still a little bit surprised. Earnings estimates from the analysts are coming down a little bit, at least in the US. They're pretty stable still in Europe, and I'm puzzled by this, that analysts are not more cautious. We have seen Apple scaling back an overproduction idea. We have seen Nike yesterday struggling with the margins. So I'm not so sure if this earnings season will be another surprising thing like we saw in the second quarter. And that's something that investors should keep in mind, that there could be more bumps ahead from corporates reporting, and margins will certainly be the one to keep an eye on.
Yeah, Apple, Micron, Nike, just the latest, as you say, to warn on inventories and sagging demand. In terms of the S&P, though, it hasn't broken through that June low. How much comfort should we take from that, JP?
A little bit, at least, because we always know when like these major marks are being broken, then there is more pressure on the market from short-term and technical people selling into it. So that it helps shows you that at least there's some signs that the market might have bottomed out. We also saw the VIX rising yesterday, but not making a new high. This is also giving a little bit of comfort. And so the chances are, unless we get like another blow from the fundamentals, that the market could at least consolidate on that level. A big rally ahead of the earnings, I'm not so sure if this is really happening. I said earlier this week, I'm not sure this is going to be more than a day.
JP, thanks so much. JP Barnett there with some of the moves. Now that's it for the European Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
a digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Market mayhem. The S&P 500 drops to a 22-month low as the Fed's Loretta Mester says U.S. recession will not stop Fed hikes. Popularity contest. The UK's Labour Party surges to the biggest poll lead over the Tories in over 2 decades in the wake of Liz Truss's mini-budget. Plus, crisis talks. EU energy ministers are set to approve emergency intervention, but a deal on a gas cap remains elusive. So good morning, everyone. Happy Friday. We've made it just barely to Friday. So I want to applaud everyone who have had a pretty volatile week when it comes to the markets. Now, some of the volatility or certainly some of the turmoil that we saw in the last 5 days now, abating a little bit. European stocks gaining 1%. There's a potential recovery, of course, after the tumultuous week in the markets. The FTSE currently gaining 0.7%. The S&P 500 futures, after that huge move in U.S. markets yesterday, also gaining a touch. Now, the dollar's pretty much steady. The pound actually rising as, once again, investors weighing some of the risks emanating from the debt crisis gripping the UK. So I don't know if we have a currency moves or whether we just go straight to the European map. But overall, it's the fears of this global recession mounting as a threat of higher rates are sapping growth. So the market in the balance today, focusing, of course, on the ECB, maybe some of the earnings, as we also are at the end of a quarter, and so there's a bit of positioning on portfolios. Now, British Prime Minister Liz Truss's sweeping tax cuts may end up being bad news for mortgage holders. That's telling. Well, these are fears that the BOE will have to hike more to compensate for looser fiscal policy. Joining us now is Marcus Ashworth from Bloomberg Opinion and Agnes Belaish, Barings chief European economist. So thank you both for joining us. Marcus, I mean, look, what is going on? So pound has had a pretty crazy volatile week. BOE intervened for financial stability. What happens next week?
Well, I would like to say that the worst of the crisis is over. I think the Bank of England has acted admirably here and stepped in and done exactly the right thing. And I don't think it will be anything close to 65 billion they'll end up buying. It may be as little as 10 to 15 billion, but we're seeing sort of only about 1.25 billion coming through each day. But we go out to the next 2 weeks, the middle of October, and then in theory they stop. The question will then be is whether the Bank of England feels brave enough to reassert its active quantitative tightening program at the back end of the month. I think that might get pushed out to next year, but we'll have to see how things are coming on. It's the end of the quarter and the end of the sort of half-year end for Japanese investors. So I think this next couple of days, we should see things calm down as we go into the fourth quarter. But it was a horrid scare for the UK, and I'm hoping that things will settle down. But there are some major underlying problems with the structure of the market for sure.
Yeah. So Agnes, what do you think the BOE does next?
So the BOE is sort of giving the government a second chance. It's telling the government that they're going to wait for the assessment of the Office for Budget Responsibility before taking policy action. And that's very wise, and you can see all the experience of Governor Bailey. However, if the government doesn't take that second chance and doesn't come with a funding program for its generous fiscal package, then the BOE will not flinch, and that's when it's going to be difficult for everyone.
So, Agnes, I mean, I know it's extremely difficult, actually, to see what happens in the kind of scenario. Given you think the BOE has given them a second chance, I mean, how do we find out what the government wants to do? Do we just wait for them to tell us, or do you look at signals from the OBR? It's very difficult and uncertain times for part of these markets.
I think the government is getting the signal. I believe seriously that they will come with a financing plan. It's a matter of time. They hadn't realized that this was part of what they needed to announce. There are a number of measures that they can use. They can cut some spending. They can also introduce some new taxes. There is a battery of instruments that they can use. I seriously think they will consider what it is that they can do. They are basically selling households a call option where they are offering where the government is offering to sell households as much energy as they want at a fixed price that's below the cost to energy companies. The losses can be huge, and I think this is dawning on them that financing those losses is necessary for some coherence in this program, which by itself, if it was funded, would not be that bad.
Agnes, we're also getting some breaking news out of the BOJ. It's boosting some super long JGB buying for October and December. Marcus, this is basically, I guess, some of the fault lines. Our central banks around the world getting ready. We have seen the BOJ in the past actually not wanting to intervene too much. I don't know whether this experiment works or not, but if you look at what happened in the UK, is it really a warning signal, Marcus, for other countries in Europe? And how do other central banks around the world react?
Hugely. I mean, the Bank of Japan we always thought was going to be the one that would break first, not the Bank of England. The structure of the UK pension industry has perhaps caused the fault line. No one fully appreciated how serious it was. But the Bank of Japan, they are just underlying again and again, they're prepared to defend all the way to the very end as far as the things that they can control, what they want to do, which is break their cycle of deflation. They're the only major central bank that needs to do that, feels it still needs to do it, and is continuing to do it. I think what we think with the Bank of England, the warning was that they quickly had to revert back to QE, and that really is the warning that the European Central Bank in particular should take. The UK has a unique little problem in its pensioning, but the wider problem of what's happening with a strong dollar and rising US yields, forcing everything else up, is what's going to cause breakages across. We saw, weirdly in the UK, but it's evident that the problem is coming with that inflation close to 11% in Germany. The ECB has got a real dilemma whether they're going to cause a recession, which I believe they will do. They continue to hike rates too hard. And that's why I think the Bank of England, despite all this stuff, won't go as much as perhaps markets thinking.
Yeah, and this also, Agnes, overall, how you put it is basically markets are licking their wounds before being caught up, in these different signals between fiscal and monetary policy. How much will this impact decisions in other countries in Europe?
Everybody is looking at the UK. The UK has grabbed the headlines again with quite a daring plan. And, other countries in Europe have had a debt crisis already. They have put together a straitjacket of a budget process so that such things would never happen there. But I think the route on the UK gilt market is telling them to really look at what's happening with positioning in long maturity bonds and what type of selling off of fire sales might happen if the regulation is too tight on this or the other. I think that's the experience that everyone is looking at, this financial stability concern. I think Europe and the euro area more specifically would not have any chance to meet such to show such a badly designed budget plan.
Yeah, thank you. And Marcus, I guess, the other question is, do you think QE for financial stability was right? Was it right for the BOE to use that?
Oh, absolutely, and that's exactly what it needed to do. I wish I could agree with Agnes on her last points, but I mean, this is exactly the type of attitude that in 2011 got Europe into so much pain. There are a lot of problems with European financing. You just have to look at Italy's debt to GDP and the structural rollover they have to finance. It won't be like the UK, it will be different, but the basic problem here is that massively higher interest rates are going to cause all sorts of problems in weak and unstable economies, which obviously have a major crisis with Ukraine and energy. So I don't think we can be complacent on this at all. And I think that all the central banks have to be very careful as they step forward here. But the singular fight against inflation, trying to land economies on a head of a pin of a 2% inflation target, is looking backwards and not looking forwards to how the structure of the economy is changing. So I hope there'll be a little bit more flexibility coming from the central bankers and learning a horrible lesson which the UK has delivered. It is unique to the UK in certain ways, but the broader problem is universal, I'm afraid.
Agnes?
Well, the EU has a straitjacket of a budget process with a lot of unpalatable peer reviews of each member state's budget. So in terms of budgeting, which is the source of the financial instability in the US, the lack of funding for the budget, that cannot happen in neither the European Union nor the euro area. There is a two-pack, the six-pack, the European semester. The European Commission has to give its feedback on every single national budget. Every government has to provide a national budget by the 15th of October every single year. And the peer review ensures that there is no incoherence in the budget, and that's as clear as that. After what happens on the market and what central banks can do or will do, and whether this very complicated transitioning process out of very easy financing conditions, that can create trouble. But the problem in the euro area will not come from unfunded budgets.
Okay, thank you. I mean, I'm loving this Marcus Agnes combo, so we'll get you back on together. Marcus Ashworth there from Bloomberg Opinion. Agnes Belaish, Barings Chief European Strategist, stays with us. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Hurricane Ian is regaining strength over the Atlantic and set to make landfall in South Carolina later today. That's after leaving a path of destruction across central Florida, destroying homes, roads, and the power grids and leading to unprecedented floods. Power was knocked out to more than 2.6 million homes and businesses. ABC News reports at least 9 people have now been killed. Meanwhile, President Biden has denounced Russia's plan to absorb occupied regions of Ukraine as a flagrant violation of sovereignty and territorial integrity. Moscow says it plans to sign what it calls treaties in Ukraine's east today. This comes after referendums on annexations condemned as illegal by the United Nations. HSBC is considering vacating its global headquarters in London's Canary Wharf when its lease expires in early 2027. According to an internal memo, the bank is aiming to create a more flexible workspace. Options include renovating the existing building or moving to a new premises in the British capital. The company says it's not planning to leave London. And a full Tyrannosaurus Rex skeleton is to be auctioned in Hong Kong in November and may fetch up to $25 million. The fossil named Sheen was unearthed in Montana and is around 66 million years old. So if you're wondering if you've got enough space, well, Sheen is about 13 meters long and weighs in at 1.4 tons. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
I'm crowdfunding for it. I think my husband sent me like 25 emails saying like, what, are you nuts? But hey, you know what? If I get the crowdfunding, maybe we'll display it at Bloomberg LP. Coming up, EU energy ministers meet in Brussels to try and come up with joint measures to tackle the ongoing energy crisis. More on that story next. This is Bloomberg.
is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, EU energy ministers gather in Brussels today as the bloc fights to come up with a joint measure to tackle the ongoing energy crisis that risks upending European economies. Joining us now from Brussels is our Maria Tadeo. So, Maria, what's the outlook for the energy ministers? How much does the price relief help, and how different is country to country?
Yes, Francine, and today we heard from pretty much every energy minister here saying this is now an energy war. We fight an energy war with Russia. The winter crisis is already starting. We're in September, but it is really here and it's happening already. We have to bring down prices. Now, there has been some relief, as you alluded to, from the heights that we saw back in August at the end of the month, where it really did seem like something was broken in the energy market. That has provided some relief, but everyone here agrees that it's not enough and bills have to go down. Now, the issue, Francine, fundamentally today, and this is a real tension that you can really pick up in this place, is the cap. Do you put a limit on gas prices? And there's a number of ideas that have been floated, but the sense that we have is that right now there isn't consensus. The energy commissioner, however, she did say something interesting. She doubled down on a cap on Russia, but then also talked about negotiating in good faith with countries that are friends of the EU, referring potentially to Algeria, Norway, and so on. But for the time being, the impression that we get is we're very far from anything that looks like a consensus plan.
Yeah, and Maria, later today, Vladimir Putin also expects to make a speech in Moscow and formally annex territories. So what happens after that?
Yeah, and for European leaders, they already say that they will not agree to this, that this is illegal, it is a fake, it's a phony. To think that a vote could be held in a country that is literally at war and Russia get away with a massive land grab is not just escalation, but also provides or paves the way for more sanctions. The other thing that will feature in this meeting today also is the leaks around the Nord Stream 1 and Nord Stream 2. Ministers here agree that there was sabotage going into this, and they say they have many questions and want to find out exactly who did this, and also what is the purpose, what is the point of doing this. So overall, it does point to a week of big geopolitical escalation when it comes to Russia.
Thank you so much, Armenia. Today they're on the ground, of course, for us in Brussels. Now, Agnes Balázs, Barron's chief European economist, is still with us. Agnes, when you look at the energy price cap announced by Germany, what they've designed compared to other countries, can the bloc stay together and speak with a united front?
Yeah, that's exactly one more reason for which the bloc is speaking with one voice and is designing policies that doesn't leave anyone behind. I know it's a formula, but it's actually quite impressive what they're doing, because what the EU is going to announce and is preparing is actually a common set of tax-raising or revenue-raising taxes, I should say, that would enable every country to actually finance their energy support package that can shield consumers and small and medium enterprises. They have been preparing these measures for a long while. That's what they're going to discuss today in this emergency energy meeting. They will consider them next week again at the Eurogroup and later down the road at European councils. So it is something of a uniform policy blanket that every country won't have to design for itself, but can just apply for its own population. And some countries, of course, have already done it.
Agnes, and I know you were saying basically also because of the straitjacket that the body of the EU regulations provide come in handy to avoid this fiscal credibility crisis, and you argued that very well against some of Marcus's points. When you look at the energy complex in general, I mean, how many companies could go under? Does the European economy remind you of what we lived through in 2007 before the financial crisis?
Well, so governments are considering energy companies like they would systemic banks. And they are ready to bail them out, having understood how important it is for the simple functioning of the economy and livelihood of the population. So their fiscal balances are quite healthy, at least in Germany, which is the country most directly affected with the highest dependence on gas for its energy consumption. And there, they have nationalized Uniper. They have already a plan to inject financing. They have come up with a budget with a fiscal deficit of 3.5% of GDP. Debt is around 70% of GDP at the start of the year. So they would have room to do so. This is an exceptional circumstances for them. So Germany stands apart in this plan. Some companies might go under, but the bailout will be there from the states. And of course, it's Germany that's the most directly affected.
Agnes, thank you so much for all of the insight. Agnes Belaish there, Baring's Chief European Strategist. Now, coming up, GDP data this morning shows the UK has narrowly avoided a recession for now. Ahead of Liz Truss's first Conservative Party conference as leader, we break down the extreme UK market moves of the past week. That's a little bit later in the program. This is Bloomberg.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we've seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance, or the edition. I'm Francine Lacqua here in London. We're just getting a bit of breaking news. China FX body said to ask banks to trade yuan closer to fixing. Now, this comes, of course, for party politics, and usually when China asks, it gets done. So I don't know if we have a renminbi chart or whether we'll get that to you. It'll probably take a couple of other days, well, more days for it actually to play out. Let's also get to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Meta has outlined sweeping plans to reorganize teams and reduce headcount for the very first time. CEO Mark Zuckerberg says he is freezing hiring and restructuring some units to trim expenses and realign priorities. He also said Meta will likely be smaller in 2023 than it was this year. It is the company's first major budget cut since Facebook was founded in 2004. Now, Canada's National Housing Agency is set to revise its forecast, saying house prices will drop as much as 15% by the middle of 2023 from levels seen earlier this year. It says higher mortgage rates threaten to cause a protracted slump in real estate. Its July forecast was for a 5% slide. SoftBank Group is said to have started laying off employees at its loss-making Vision Fund. Bloomberg has learned that it is expected to cut at least 30% of staff from the London-based unit, which has about 500 employees. The Vision Fund recently posted a $23 billion loss, with most of that coming from a plunge in valuations from its portfolio companies. And Amazon is to close all but one of its U.S. call centers and shift hundreds of office employees to remote work in an effort to save on real estate. The e-commerce giant has been seeking to reduce expenses as sales growth slows amid rising inflation and also economic uncertainty. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. This is the picture for the markets. Stocks actually dropping in Asia. Today, they seem to be stabilizing in Europe, but it is also the end of the quarter, so look out for any dollar swings. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
Market mayhem. The S&P 500 drops to a 22-month low as the Fed's Loretta Mester says the U.S. recession will not stop Fed hikes. Popularity contest. The UK's Labour Party surges to the biggest poll lead over the Tories in over 2 decades in the wake of Liz Truss's mini-budget. Plus, crisis talks. EU energy ministers are set to approve emergency intervention, but a deal on a gas cap remains elusive. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK economy grew in the second quarter, averting a summer recession despite the cost of living crisis. The news will be welcomed by the government, which has been hit by a run on the pound and a financial crisis since the mini-budget last Friday. Well, for all of this, we're joined by Lizzie Burden. So first of all, Lizzie, break down the latest eco data for us.
Well, Francine, I have to cast a healthy dose of skepticism on this. Yes, GDP surprised better than the estimate, I should say, for Q2, but that just means the slump is delayed. We are expecting a slump from the third quarter, when of course we had the National Bank holiday for the Queen's funeral, and the somber national mood is likely to have weighed on sentiment. We also had the house price figures from Nationwide this morning. They showed that there was no growth in September. It's the first time that's happened in more than a year. So you are starting to see the weight of inflation and higher interest rates on the housing market. So yes, the government might well welcome this news about the second quarter GDP and the pound's recovery, but on the pound, that is more likely to be perhaps because the Bank of England has shown that it's willing to step in.
So, Lizzie, what's the mood heading into the Conservative Party conference this weekend? Not good, I imagine.
No, bleak. This poll from the Times, from YouGov, shows that Labour's got a 33-point lead. It's the biggest lead for any political party in 20 years. And, of course, it comes back to the budget. Now, behind the scenes, Kwasi Kwarteng is pleading with Tory MPs to get behind the economic policies. But what we're hearing is that lots of them want him to resign so that Liz Truss has the political cover to reverse these tax cuts, but that's not looking likely. Kwarteng and Kemi Badenoch, the Trade Secretary, came out yesterday defending the plans, and so it's bleak going into this conference when you've got big heavyweights like Rishi Sunak staying in his constituency to give Truss space.
Lizzie, thanks so much. Lizzie Burden there with the very latest on the UK. So let's stay on the story. Joining us now is the former Bank of England Deputy Governor. He's Sir John Geeve. Thank you so much for joining us. How was your week?
Exciting, hasn't
Eventful.
it been? Yeah.
I guess it is maybe one way of putting it. Do you think that actually Bank of England using QE for financial stability was a good idea?
Yeah, I think if you look at the results, I mean, they faced an unstable market because some pension funds, and I guess other people too, had been caught out by the speed of the move on gilts and were facing collateral calls which were causing them to sell assets. So there was a risk of a spiral developing, and they did stop that, and they've done that effectively. But, of course, that's only a short-term move. So they've said very clearly that's not QE. We're going to stop in a fortnight. We're just giving people a pause in which they can sort out their affairs, and then we're going to get back to selling gilts. So it's a pause, not a change.
But it is also, it does set a precedence. So actually, how bad does it have to get in other parts of the market for the BOE to intervene?
Well, the bank's got two remits. One's to get inflation down. That's why it's selling gilts. That's why it's putting up interest rates. The other is to keep markets stable. And I think, yeah, this is I can't remember a similar occasion when they've stepped into that particular market so forcefully, and to do whatever it takes. I mean, they were taking on the sellers and saying we will absorb it, and that had the impact they wanted. Would they do it in other markets? I guess they would if they thought it was going to disrupt the rest of the economy. And what was happening in those markets was that as long-term interest rates began to be very volatile, the banks stopped their mortgage offers. So they didn't know how to price their mortgage offers. So you could see a direct impact from this sort of rather arcane derivatives market to the high street and mortgage offers.
But do you think QE should have always been used as a financial stability tool? Is that actually the best usage of it?
Well, no, I think the bank would say this isn't QE. This is a limited market intervention. QE is something different. QE is what you do when interest rates are near zero and you can't reduce them any further. I think genuinely there are two completely different motives at work here. And I don't think the bank wants to get into the business of underwriting every financial market. So this was a special occasion, and I think it's worked. But it doesn't resolve anything. You know, this storm isn't over.
And I mean, you're mentioning the fact that, you know, they could go back to their previous plans in 2 weeks. Is that like very optimistic? It could take longer, right? If something doesn't give.
Yeah, I think on the particular point that they were targeting was this collateral calls on derivatives linked to interest rate swaps and the pension funds and so on. And basically, high interest rates are good for pension funds, so they are more solvent than they were. This was a real cash flow problem. So I think a 2-week intervention should give them enough time to get their cash flow in order. So I think they will stop in a fortnight. But of course, that may lead to gilts falling again because and 2 weeks after that, on October the 31st, they've said they're going to resume selling gilts. So it's, I think if they find at the mid-October that they can't stop underpinning the gilts market, that would be very serious and would take them into new territory. So I'm expecting them to do what they say.
But are you expecting more market dislocations, again, as we try and understand what the government will do with this mini budget, their relationship to the OBR, and also how markets react to it?
Yeah, well, there are two things unresolved from this week. Firstly, the banks, what's he going to do with interest rates? I mean, the expectations have gone right up. People are talking about 1.25%, 1.5 percentage point increases at the next meeting. So expectations are very high that they're going to tighten policy sharply. But we don't know about that. The second thing is the government has said it's going to publish its fiscal medium-term plans, it's going to have a proper forecast, but only at the end of November. So we've had the good bits of the budget, i.e. the giveaways, didn't go down too well, but nonetheless, I mean, that was the nice bit, cutting taxes. What they haven't explained is what does that mean for spending in the medium term? And I think they've got some really difficult political choices to make. I mean, you see in today's papers, they're talking about maybe cutting benefits. Now, it's one thing to say you're cutting tax on the best paid people, but it's all right, it's all on borrowing. If you're saying, well, we're cutting tax for the best paid people, but actually we're now going to squeeze the poorest people in order to pay for it. These are, I think they face a real difficulty in producing those medium-term plans. And those two big uncertainties remain. And I suspect that they will have to do something before the end of November in order to clarify where they're going and how they're going to pay for these tax cuts.
So given these unknowns, given what's priced into the market, what do you think the BOE should do? How big a hike can they afford to do, you know, in the coming weeks?
Well, the bank has felt it's really pushed the boat out in going on 50 basis points. And I think they'll probably have to do more. And the comments from Hugh Pill suggest that they're talking about something big next time. They won't have decided yet. But my guess is that they'll want to raise rates up towards or up to the level that they are in America. I think that there's a real, what this week has shown is the market's real doubts about the credibility of the economic policy makers in Britain. And I think the bank must show its independence and its willingness to take tough action. So I'm expecting at the next, they hope to wait till November, at the next meeting, they'll probably go up by 0.75% or even 1% in order, as I say, to close the gap with American rates.
Can they really wait until the next meeting? Again, it's a difficult, if they act before, then it could, spread a sense of panic, but it also feels like a very long time away.
Yeah, well, I agree with that, and I say they've stabilized the markets, and there's been a calm for the last day. That's just one day. Yeah, absolutely. More things could happen, and we've seen they didn't intend to do this a week ago. They intended to start selling gilts. So I'm not making any promises or predictions about how easy it will be to fill that gap. I think if the government sets out during the next month a credible medium-term fiscal plan, the bank probably won't have to step in again with special measures. If they don't, then I think some of these political difficulties in creating a plan like that, people are going to think, well, can they really do it? And then markets may get nervous again.
So we talk often to Mark Carney about climate change, and he's always said, I don't want to talk about the UK economy. So for him to give an interview means that he was quite alarmed about what's going on in the UK, and he says, look, Liz Truss has really put the credibility of the UK institutions in this. What does that mean for the UK, for UK businesses, for the UK economy? Do you think outside investors are now questioning the country?
Yeah, well, I'm another ex making comments about what the current people are doing, but I think it's put the institutions to test. But actually, the last week has strengthened the hand of the Bank of England and, in fact, the Office of Budget Responsibility, who do the independent forecasts. I mean, now, she's meeting them today, the government's got to accept what they produce. So, although people may have worried that she was sort of downgrading the OBR, less convinced about the Bank of England, I think this has been a reality check, and if anything, the strength of those institutions to say this is how we're going to act and you've got to adjust to it is greater.
When you look at these forces, the UK, but also in the world, do you worry that the world economy is as precarious as it was in 2007, pre-financial crisis?
No, I don't think so. I think looking at the world stage, obviously inflation's got out of the bag.
Yeah.
A completely different situation actually to the financial crisis, and maybe they were a bit slow in the pandemic to see what was coming, but I think now they're on the case. Interest rates are rising. It's very painful. I think we will see a recession across the West, but I don't see that the financial markets should implode.
A final question, because we talk so much about the Bank of England, but at some point you're also private secretary to the Chancellor. What advice would you give to this Chancellor?
Well, I think my advice is the more you want to spend, the more you have to spend time convincing people that you'll be virtuous tomorrow. So to just produce 70 billion extra borrowing for the next 6 months, several hundred extra billion over the next few years, without any explanation of how you're going to pay for it, how you're going to bring it back to balance, I don't think he'll be doing that again.
Thank you so much, Sir John Keefe. They're very diplomatic. The former Bank of England Deputy Governor joining us on what's happening in the UK. Now, coming up, more on the UK economy. Liz Truss's sweeping tax cuts may spell bad news for mortgage holders. So we look at the mortgage market next. This is Bloomberg.
a digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
A weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in that space full time, I think it's very hard to run a successful crypto fund.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're seeing two headlines across the Bloomberg terminal from China. So China policymakers being a bit more wanting to intervene more on the markets. Again, this was something that 2-3 weeks ago the market was disappointed that China was not doing enough. China now saying it's offering income tax breaks for some home purchases. That's to try and kickstart, of course, some of, not mortgages, but really house prices, one of the biggest linchpins for the Chinese economy. And they were saying just about 10 minutes ago also that they will do some things when it comes to FX. The China FX body saying they will ask banks to trade yuan closer to fixing. Now back to the UK, and Liz Truss's sweeping tax cuts may end up being bad news for mortgage holders amid fears that the Bank of England will have to hike rates faster to compensate for looser fiscal policy. Well, deals for house purchases have been collapsing after lenders pulled mortgage products in response to soaring rates and market volatility. Now, for more, we're joined by Jonathan Tice from Bloomberg Intelligence. Jonathan, thank you so much. Great work actually trying to get this through and some of your reporting. How are the banks reacting today to the uncertainty?
Good morning. Well, as your previous guest mentioned, because of the demand for some of the kind of legacy rates that are out of kilter with the incredibly quick moves in the market, they've been pulling offers and repricing, and in some cases not even repricing yet. So a good example is HSBC. If you'd wanted a 95% loan-to-value mortgage with them at the beginning of August, you'd have been offered about 3.7, 3.8%. As of last night's close, that was 6.65%. So they're hiking rates, but clearly there's still no visibility. So with the swap rates that are used to price curves moving around so quickly, I would actually suspect that a lot of these offers, if you applied for them, doesn't mean you're going to get it approved either. This is a very fluid market, and it's only going one way.
So, Jonathan, which areas out of all of these, the mortgage market, are you most concerned about?
Well, I think the high loan-to-value first-time buyer end is a real concern, because if you look at pricing over the past few months, because if you recall, the government introduced a Help to Buy scheme with effectively a guarantee at 95% loan-to-value level back in 2020. Some banks, NatWest, Barclays, for example, they will only offer mortgagees that price if they've got the guarantee. And because of that, the pricing has been very similar to a much bigger 75% loan to value with a bigger cushion pricing. The question is, that guarantee expires at the end of this year. Even with the stamp duty cuts, what happens to that very important step on the market? We're waiting and seeing, but already we can see prices move a lot faster, a lot more quickly. And you think the politically unfriendly headlines that will accompany the fact that first-time buyers, younger generations, will be effectively shut out of the market again, as they were when all the offers disappeared in early 2020. That's definitely an area that we're expecting to see more in.
Jonathan, thank you so much for joining us. Jonathan Tice there from Bloomberg Intelligence. Now, coming up, Euro-wide inflation numbers set to be revealed very shortly. So we'll look at what it means for the ECB and its fight against rising prices. That's next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
We have to get interest rates higher and bring inflation back to our target.
33 million people have been affected by this flooding in the monsoon.
Disruption is the whole point of a strike.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We will do what we have to do, which is to continue hiking interest rates in the next several meetings.
I think for most of us, all of us, 50 may be the minimum.
I would say my choice would be 75 basis points.
Some were asked, could it be 100? It could, but I don't see the necessity now to go as fast.
It's also clear for now that we are below the neutral rate.
As long as we don't get to the peak of inflation, we will not have a clear path in terms of how far we need to go.
Most probably it's somewhere around 2%, but I accept that there are different views.
I wouldn't be surprised to see even higher inflation for September for euro area than 9.1% that we saw in August.
The distance to the interest rates that would ensure 2% inflation over medium term is still relatively wide, so we can take big step to speed this up.
And this is what we have to do. Returning inflation to 2% in the medium term.
If we go back and forth, this will send mixed signals to the markets, to the agents, to our citizens, and that's bad.
From hawkish to quite dovish, a range of different tones there from the ECB's Governing Council. Now, the latest euro area inflation figures are due to be released in the next few minutes. It's likely we'll see record numbers. So for more on all of this, we're joined by Bloomberg's Jana Randa. So Jana, how much pressure, and a lot of pressure, and it's also so great to have you in London. Now, how much pressure is the ECB under?
A lot. Whatever the rate will be, it's going to be really bad. It's going to be close to 5 times the ECB's target. Economists are predicting a rate of 9.7. That is far too high by any standard. And we've seen policymakers very nicely in this video basically saying 75% is what they expect for the next meeting. That's about 4 weeks away. A lot can happen still. That's what Philip Lane said. So, he was pushing back a little bit yesterday, saying there is still time. Let's wait until we commit. But yeah, if they're true to their words, being data dependent and wanting to get inflation back to 2%, then there is a clear path.
So if you look at that path, right, what can we expect for the rest of the year? And again, there's all this political turmoil in certain countries that complicates the situation even more.
Absolutely. I think the first priority for policymakers there, and the president, Christine Lagarde, lined this out quite nicely, is to get to the neutral rate. Now, that in itself is a concept that nobody quite understands. So our best guess is somewhere around 2%. Yeah. And if you look, we are at 75 basis points on the deposit rate now. Another 75 puts us to 1.5. There's another meeting coming up in December. So in the order of magnitude of 50 in December, 75 maybe, who knows, will depend a lot on data forecasts. Get to neutral, talk about QT, and then see if more on the rate front on restrictive is necessary. And then the recession comes in and makes it all more.
Said like that, it just sounds so simple, right? Do this, do that, everything's fine. But then you look at the UK and the turmoil that we've seen. So what's the implication of that on the Eurozone, for example?
I think what this is a big warning sign flashing there, mainly to governments that what can be perceived as reckless fiscal policy, as very irresponsible fiscal policy, can actually create a lot of market stress, a lot of market tension, and it can have real implications on what the central bank needs to do. Policymakers there in the ECB world and Euroland have pointed that out, saying they want to see targeted and temporary, very tailored measures to basically help consumers, companies through this crisis. They don't want to see blanket support, because that is a stimulus in itself that will drive prices, go counter to what the ECB is trying to do. And Lagarde has been very outspoken. She said, look, you guys better do this, otherwise we are going to be forced to act even more. You're not going to like it, so you're well advised to pay attention.
Jana, thank you so much. Jana Randau there from the ECB team. Miss Scoop Machine. She always gets the scoop, so check her out also on Twitter. Bloomberg Surveillance Early Edition continues in the next hour with Katie Greifield and Kaylee Lyons in New York, Anna Edwards here in London. This is Bloomberg. Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points, and so that's what we're doing.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. There's growing frustration that not enough's being done to solve Europe's natural gas crisis. EU ministers are meeting in Brussels to try to come up with a solution. The pound bounces back. Traders are now speculating that the British government will have to backtrack from policies that sent sterling plummeting to an all-time low. And Nike falls as profitability shrinks and inventory builds up. The largest US maker of memory chips, Micron, is slashing production in response to plunging demand. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kaylee Lines in New York. Matt Miller is off today. Welcome to the program, Katie. And Kaylee, the markets look really different today after a lot of heavy selling earlier on this week. Well, what's to worry about, it seems? Risk on today.
Well, we'll see how long that lasts. It's been a bit of a roller coaster, Anna, on this very last trading day of the month of September and the third quarter. It is hard to believe we are here already, but it's been a pretty rough third quarter for a lot of assets, including for Asian equities. The MSCI Asia Pacific Index as a whole is set for its 5th consecutive quarterly loss. That is the longest streak of quarterly losses going all the way back to 2009. On a monthly basis for the month of September, it was the worst since 2008, and with a decline of 0.4% today, we're looking at a 7th consecutive weekly loss. In other asset classes, of course, it has also been a story in the bond and foreign exchange market. In the bond market, we are seeing pressure put upward on yields globally, and that has been a bit of a problem for the Bank of Japan, which is trying to maintain that 25 basis point cap on the 10-year JGB yield. That is why you see them announcing even more bond buying overnight. That seems to be having somewhat of an effect as that 10-year yield is down around 24 basis points. But of course, the keeping of yield curve control and easy policy has been a continued weight on the Japanese yen, though it is gaining some strength against the US dollar today, right now trading at 144.28. Of course, Japanese officials seem to have drawn a line in the sand around that 145 level. That is where intervention stepped in, and they're also setting the stage for intervention in the Chinese yuan, which is weakening fractionally against the dollar once again today. We are back up at a 710 level, Katie.
Well, Kelly, it is unambiguous in early U.S. trading that it is risk on. If you look at S&P 500 futures, up about 1% or so, inching there. Same thing if you look at the crude market as well. You have crude up above $82 a barrel, up about 1.4% at the moment. And Bitcoin singing the same song, up about 0.5% so far, actually underperforming equities right now. It had been the reverse dynamic earlier in the week. But one of these things is not like the other, Anna, and that's what we're seeing in the Treasury market. You actually have yields falling to the tune of 7 basis points on the benchmark 10-year Treasury yield. So we'll see which of these wins out as the day goes on.
Yeah, absolutely. We'll see how that plays out, that dynamic. We're risk on here in Europe when it comes to stock markets then, Katie. We've got European stocks moving higher, up by around 0.9% in the German market and in the French market. It's pretty broad-based, actually. We see banking stocks, real estate stocks recovering some of their lost ground. There's a bit of read across from negativity after hours in the United States. We'll come to that in just a moment. Let me get to some of the breaking news out of Europe. We've had inflation data that's come through for the Eurozone. Hasn't moved the euro all that much, I can report, but euro area September consumer prices rising 10% year on year. The estimate was for an increase of 9.7%. So we are now in double digits in terms of inflation for the whole Eurozone. That is the aggregate. A lot of diversion geographically around that average, of course. But that's where we are, 10%. I guess we were sort of primed for this yesterday when we got the German number. That came out in double digits. And so the market possibly was looking ahead to something that might beat estimates. And that's what we got this morning. So that's why I didn't move the euro, which was already a touch higher and remains so, 0.98 at 2.9. The two-year yield then, in keeping with what Katie was talking about, where the yield dynamics are going this morning, we've got yields coming down, but that seems to be a story across the globe, not really specific to the UK. There's been a lot that has been specific to the UK over the past week, but not the moving yields today, it would seem. So 4.13% is the yield on the 2-year. The pound is at 111.94, so we bounced back on the pound. What is driving this, though? Is it fundamentally different assessments of what we heard last week? Not particularly, according to strategists. It's more to do with the lead that the opposition Labour Party has now built up in the polls, the highest lead from any political party in the last 20 years. Will that put pressure on Prime Minister Liz Truss to U-turn, to backtrack on some of her plans? She's also meeting with the fiscal watchdog, the OBR, a little bit later on today, so we'll watch for any news out of that. And this is the transatlantic read across I was talking about, Kaylee, down by 3.9% on the Adidas share price. Nike, of course, giving us something to think about. Even though Adidas had already given us a fairly gloomy assessment of where we were, it seemed there was further downside to go.
All right, Anna, well, you were talking about the inflation story in Europe, and of course, energy is a huge part of that. And today, European Union energy ministers are meeting in Brussels to agree on a set of measures in order to tackle that gas crisis. We heard from the Czech energy minister earlier, who says more needs to be done.
We are in the energy war with Russia. The winter is coming, and we need to act, as I said, now. Now means now. Now is today, maybe tomorrow. Now is not in a week and definitely not in a month. So I expect the Commission to come with additional measures as soon as possible.
All right, so more needs to be done. Let's find out if more will be done. Maria Tadeo, our European correspondent, joins us now. Maria, will the gas cap happen or not?
No, Lala, what a question. And it is fundamentally the big debate happening here, and you can feel it. There's a lot of frustration this morning when European ministers are gathering. This meeting is on its way now. It's underway and it's ongoing. But the fundamental issue, and we go back to what is always a perennial problem for the European Union, is that these are 27 different countries with 27 different systems. And the issue right now is that they don't have a formula for it. They all agree and concede this is an energy war. We need to bring down prices. Bills need to go down. Inflation needs to go down. But they don't have the magic formula for the time being. There is frustration. There is disappointment today. And from what I hear, the bar is pretty low. We're not going to get any progress out of this meeting, which that increases the pressure now for European leaders next week when they meet in Prague to come up with some type of solution.
And Maria, of course, Germany announced a massive package. But does European unity still hold?
Look, and that's a very good question, because yesterday the German chancellor came out with 200 billion euros to shield what he said would be German households and businesses from this energy winter crisis. Now, there is this morning behind the scenes some criticism that, if anything, this will create more distortions. And you have to remember that Germany is a country that says they do not agree with a gas cap. They feel that could lead to disruptions in the energy market. Well, the flip side for some of the countries that do not have the fiscal space that Germany has is that, well, maybe it's Germany, after all, that's creating the biggest disruption of all.
Yeah, absolutely. We've heard from the Germans this morning. Maria, just to keep us all up to date, just a red headline across the Bloomberg says that the EU is backing a package to cut power use and allowing a windfall profit grab. Just briefly, Maria, that is in line with our expectations, isn't it? That they are planning to cut power use and allowing a windfall tax.
And completely digested and priced in by the market. This was in fact announced by Ursula von der Leyen 2 weeks ago in Strasbourg. This is completely known and digested by markets. The real question, and that of course there's no deal on it, is what to do with the gas prices, Anna.
Okay, perfect. So we'll get we'll get more thoughts, of course, from the team in Brussels if we get any news on those gas prices. Thanks to Maria Tadeo reporting there from Brussels. Let's focus in on the UK economy. It grew in the second quarter, averting a summer recession despite the cost of living crisis. The news will be welcomed by the government, which has been hit by a run on the pound and a financial crisis since the mini-budget last Friday. Let's get more with Bloomberg's Lizzie Burden. Lizzie, I mean, I don't want to sound too surprised at the growth, but it was because the expectation was for a number that was not growth, that was for contraction. This is going to set the mood to some degree for the Conservative Party conference that lies ahead. What do we expect?
And don't forget, we're still expecting a slump to start in the third quarter when, of course, we had the national bank holiday for the Queen's funeral. And we're looking at the pound's recovery, but perhaps that's because the Bank of England has stepped in and shown that it's willing to help out. In terms of the mood heading into conference in Birmingham, the Tories are behind in the polls. There's a new poll overnight showing that Labour is ahead 33 points. That's the biggest poll lead for any UK political party in 20 years, all because of this fiscal package from the Chancellor, Kwasi Kwarteng. He, behind the scenes, is being weighed on to resign so that Liz Truss has the political cover to reverse the tax cuts, but doesn't look like that's going to happen. The Chancellor and the Trade Secretary have been out defending vigorously these plans, so it's very awkward. But at conference, we're expecting Rishi Sunak, her rival to be leader, to sit it out in his constituency.
And Lizzie, where does this leave us on the state of Trussonomics, if you will?
Well, it's very awkward because Liz Truss, if she carries on with her proposals, risks creating more turbulence in financial markets. Bank of America says that we could hit dollar parity within the year, but if she backtracks, she would risk her credibility. What she could do is cut spending, but Bloomberg Economics reckons that she'd have to cut even deeper than George Osborne, the former Chancellor, in the austerity years, so that would be politically unpalatable. She might get some ideas from when she goes to see the fiscal watchdog today, but I cannot understate how unusual it is that this meeting is happening at this moment. And we've been having a debate on the economics desk what it means. Is it on the one hand the government trying to weigh on the independent forecaster, or on the other hand is it the government accepting that it should have gone to the OBR in the first place, and perhaps the lack of credibility is what's roiled the markets?
All right, Bloomberg's Lizzie Burden, thank you so much for your continued reporting on this. Clearly, there is a lot going on in terms of the macro picture, but there are some micro stories we need to keep track of as well. A couple of earnings news movers that we want to keep an eye on. Nike shares are slumping in pre-market trading after inventory surged, and they were forced to push through some margin-busting discounts that hurt profitability. You also have U.S. memory chip maker Micron slashing production to cope with a steep plunge in demand. Danny Berger is tracking those names and those moves for us, and she's joining us now. Danny?
Hey, Kaylee, yeah, both of these stories, I mean, very different, but they're both kind of hangovers from adjusting away from the COVID world into something much different. So Nike, for example, it's all about inventory just being too high at a time when sales are slowing, when there's less demand, shares falling 9.5 in the pre-market session. It looks similar post-market, but essentially with all of the concern over supply chains, they really stocked up a lot. But because they had so much inventory, it meant that they had to discount their stock a lot. So margins were hurt not just by that, but also by strong dollar and just freight costs in general. And then you get to Micron. Again, it is a story of weakening demand. Micron, their estimates for sales missing by almost $2 billion. So shares are up pre-market 3.9%. It is a stress that has been largely priced in, especially to the consumer chip-facing sector, considering we had that Bloomberg scoop about Apple's warning. But it really is about the story of an earnings recession, something Mike Wilson over at Morgan Stanley and Michael Hartnett over Bank of America have been warning about. To what degree is that priced into equities? Do we need to see more cracks when it comes to the earnings story to really get equities to fair value, Anna?
Yeah, a topic of conversation that we've had for weeks, and no doubt we'll continue to have for weeks from here into the fourth quarter as we go shortly. Danny, thank you very much. Bloomberg's Danny Berger with the latest on the pre-market moves. Now, coming up on the program, we will speak to Simon French, Pamela Gordon, chief economist. He's somebody who knows the inside of the UK Treasury. He can shed some light on what's been going on over the past week and where we go from here. And on the EU energy meeting. Anne-Sophie Corbeau joins us, global research scholar at Columbia University Center on Global Energy Policy. We'll talk about the big picture from Brussels and also where all the Russian gas is going right now, plus deciding the fate of the Amazon. Today's Big Take story looks at how Brazil's election, which is due to take place this weekend, could affect the fate of the world's largest rainforest. Read more online or on the Bloomberg terminal. This is Bloomberg.
No one covers the world like Bloomberg.
Russia will then absorb these territories. What is NATO's reaction?
Italy's Giorgia Meloni wins a clear majority, ushering in the nation's most right-wing government since World War II.
Fed offers no sign that it is ready to stop tightening.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Katie Greifeld with Kaylee Lines in New York and Anna Edwards in London. Matt Miller is off today, and it's the last trading day of the quarter, so let's get a look at the cross-asset volatility. This chart behind me shows Treasury volatility measured by this blue line here, the blue index, versus the VIX index in white. And as you can see, quite a divergence has opened up. Even though it's felt like stocks have been pretty volatile, the bond market well outpacing that. For more, let's bring in Simon White. He is a strategist, a macro strategist at Bloomberg News. He joins us now. And Simon, when you think about this discrepancy that's opened up, I'd love to hear your thoughts on how these two lines come back together, whether it's going to be bond volatility easing a little bit here or whether stock volatility has to come up.
Well, it's a very strange set of affairs. So on the one hand, I think you have this very elevated bond volatility because when rates fall, when rates rise, you get rises in volatility. We've had very low liquidity in the Treasury market right now, and that kind of feeds off one itself, right? You get low kind of liquidity, that means you end up with higher volatility. But the real curious thing is what's happening with the VIX. The VIX seems, way too low compared to a bunch of different things, and it's way too low compared to, for instance, at-the-money volatility. And I think what's happening is the VIX is essentially an average of volatility across the whole curve. So people, from want to buy calls all the way down to people who want to buy puts. And what seems to be happening is that the volatility on puts is falling relative to calls. So people seem to have, bizarrely enough, lower demand for, if you like, kind of crash insurance right now. And I think that's what's been depressing the VIX.
Yeah, that's interesting, Simon, then, because would that lead you to conclude that the market is kind of convincing itself that maybe we're approaching the bottom, even though that seems to be an extremely live debate? Plenty of people saying, no, we're nowhere near that yet.
Yeah, that's exactly the conclusion I came to, because, you know, earlier on, people had the idea of what the Fed put was, and maybe the market is now thinking we're getting closer to where that Fed put is. So there's a kind of lower demand for these further out the money options, and that's keeping the VIX, as I say, slightly depressed. Now it is rising, and I think you know, I think it will continue to rise. If you look at, for instance, people buying calls in the VIX itself, so that's people thinking the VIX is going to rise from an option point of view. That's been rising, and when that rises relative to put buying, you tend to get rises in VIX. So I think the VIX will continue to rise. I think the move index will probably fall. So it'll be both. I think we'll do the adjustment, and you'll get some sort of. I don't think they'll come together, but that's how the adjustment will happen, with the VIX going higher and the move starting to go a little bit lower.
So when are we going to know when buying the dip can win again, Simon?
That's the big question. I mean, look, I think the biggest medium-term driver of equities is liquidity. There's a number of ways of looking at liquidity, but one of the best ways is what's called excess liquidity. And that's the difference between real money growth and economic growth. And right now, that's low and depressed. And not really until you see that starting to rise in a sustainable fashion, I think that you can be in a position where you think the bear market is over and you can get this sustainable rally in equities.
Simon, thanks very much. Bloomberg Simon White with the latest on volatility in the markets, where we're seeing it, where we're not, what's driving it. For more market analysis, check out MLIV Go on your Bloomberg terminal. That is the Markets Live blog. That's where it lives. This is Bloomberg.
Policy, politics, from the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is on assignment. Now, keeping you up to date with news from around the world, here's the first word. Hurricane Ian is now taking aim at South Carolina. The storm's winds picked up to 85 miles an hour overnight, and it's expected to make landfall today north of the historic city of Charleston. Ian caused catastrophic damage in Florida, where it came ashore as one of the strongest hurricanes ever to hit the U.S. The storm flooded towns on both coasts and wiped out entire neighborhoods. An unknown number of people are still believed to be trapped in their homes. Vladimir Putin is set today to annex parts of Ukraine that Russian troops control. That's after a referendum condemned by the United Nations and called a sham by President Biden. Russia plans to sign treaties to absorb the 4 Ukrainian regions. In Brazil, President Jair Bolsonaro and former President Luiz Inácio Lula da Silva traded insults in their last debate before Sunday's election. Bolsonaro called Lula a liar and an ex-convict. Lula accused Bolsonaro's government of corruption. He leads in the polls by a wide margin and could win in the first round if he gets more than 50% of the votes. And it's the end of an era at Facebook parent Meta Platforms. CEO Mark Zuckerberg has outlined plans to reorganize teams and reduce headcount for the first time ever. Zuckerberg says Meta will likely be smaller in 2023 than it was this year. It's an admission that ad revenue growth is slowing in the midst of mounting competition for users' attention. And Katie, you can see those struggles reflected in Meta's share price. I just checked it out, down 59% so far this year.
It's pretty remarkable, and you think about Meta trying to make this hard pivot into the metaverse. Investors clearly have been very skeptical of those efforts. What's interesting to me is that these are Meta-specific problems. We know tech has been suffering all year, but the NASDAQ 100, it's only down 31% this year. You compare that to Apple, down 20%. I mean, Meta is in a class of its own.
Right, yeah, indeed, for the wrong reasons in this particular case. And Katie, interesting that they are blaming the performance of the economy, and interesting that we've seen this from other tech names. There may be specifics here around Meta, to Katie's point, but there are some broader things around tech, the tech sell-off, of course, but also the extent to which we're seeing hiring freezes, like at Twitter. We've seen Google saying that it will slow hiring, for example. So this is a theme that we've seen elsewhere.
Absolutely, and we know that Meta plans to spend a lot of money on the metaverse in the coming years. We'll see maybe if those plans have to adjust slightly now that we know that there is a plan to freeze hiring, cut headcount, et cetera.
Yeah. Absolutely. We'll pivot to a more macro conversation shortly. We'll be joined by Simon French, Pamela Gordon's chief economist, somebody who knows the inside of the Treasury here in the UK. He can talk to us about what's been going on in the past week, where the UK goes from here. We're building up to some interesting political developments, no doubt, next week. A Conservative Party conference taking place at a time where the poll lead for the opposition Labour Party is at a 20-year high. That is the context for the economic conversations here in the UK. More on that next. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology.
Welcome to Bloomberg, the lineup.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. There's growing frustration that not enough's being done to solve Europe's natural gas crisis. EU ministers are meeting in Brussels. They've come up with part of the solution. What will happen with the gas cap? The pound bounces back. Traders are now speculating that the British government will have to backtrack from policies that sent sterling plummeting to an all-time low earlier this week. And Nike falls as profitability shrinks and inventory builds up. The largest US maker of memory chips, Micron, is slashing production in response to plunging demand. I'm Anna Edwards in London with Katie Greifeld and Kaylee Lyons over in New York. Matt Miller is off today. And Katie, there's more optimism in markets today, perhaps inexplicably, but we certainly had a lot of volatility to talk about earlier on this week when it came to bond markets, FX markets, not so much in stocks, but quite a lot of selling yesterday.
Oh, big time. And you look at the setup today, about 4 hours until U.S. markets open, it's still risk on, but less so. If we look at the S&P 500 index in early trading right now, it's up about 0.7%. We had been closer to 1% earlier in the morning. Some of those gains coming back now. Crude also still higher, less so. And Bitcoin still higher, but less so. Meanwhile, that rally in the bond market accelerating a little bit. You look at the 10-year Treasury yield now down about 8 basis points at 3.7%. 4% feels like a long time ago, Kaylee.
Yeah, it absolutely does. I also just have to say that I'm really proud that you knew it's 4 hours until the opening bell, because Matt has to ask me how many hours it is.
I thought about it. I thought about it.
So that was pretty impressive. I want to get a quick check on the pre-market action now, because you did have a number of companies reporting after the bell yesterday, one of them being Nike, which has a bit of a profitability problem on its hands. Gross margin came in under Wall Street expectations by 44%. The issue there is they have higher input costs. At the same time, they've seen their inventories build by 65%. So they're having to do heavy discounting in order to try to work that down. All of that putting pressure on the bottom line, which is why you're seeing Nike down about 9.4%, and it's dragging down other athletic apparel makers as well, the likes of Lululemon down by about 2%. Micron is an interesting story this morning as well. It too reported after the bell. It gave a revenue forecast for the current period $2 billion below analyst expectations. What they are doing in the face of waning chip demand is pulling back on supply and capex. So maybe the fact that they're adjusting is what traders are taking a little more kindly to this morning, with that stock up about 3.5%. And one other company will be reporting before the bell, so in just a few hours later on this morning. That is Carnival Cruise Lines. Of course, we've seen it come under a little bit of pressure in recent days due to Hurricane Ian in Florida. But right now, ahead of those results, it's up about 3.6% before the bell, Anna.
Kaylee, we've got European equity markets making gains today, up by just shy of 1%. Of course, we lost substantial ground yesterday, and we're not making up all of that today. But we are seeing a little bit of a rebound in risk sentiment, perhaps because of the weakness in the dollar, giving risk assets a chance to rally. But we're up by 1% on the European stocks this morning. We're rethinking some of the weakness around UK assets. Just today, we spent the whole week talking about weakness in the pound, higher gilt yields. Those two trends have been unwinding a little bit, and we seem to be back to where we started, really, on the pound. But some of the threats still remain. The Bank of England has been actively calming nerves, it seems, in gilt markets. That's spilt over into the FX markets, perhaps. But also, perhaps investors are betting that there might be a U-turn, a political U-turn and a rethink from the governing Conservative Party. And that might be what is behind the bounce in sterling that we're seeing. That has been certainly something mentioned by strategists. And in keeping with that, we see that the two-year yield, and in fact, across the curve, and this is more of a global theme today, we do see risk-on moves and yields coming down a little bit. Adidas is down by 4%. This on the back of what you were talking about, Kaylee, that Nike story. So Adidas, or Adidas if you prefer, is trading weaker, even despite the fact they've already been downgraded by a number of analysts this cycle. And they'd already told us some of the gloomy things to do with their trading situation. But of course, that read across came loud and clear from Nike over the Atlantic.
Yeah, if Matt were here again, he'd be giving us a lesson on the proper pronunciation of these German companies. I do want to get back to the UK story, though, as well. Joining us now is someone who definitely has thoughts. Simon French, Panmure Gordon, chief economist, who has been on fire on Twitter over the last week, since a week ago Friday when Kwasi Kwarteng shook the world. Anna was just talking about, Simon, how the pound is basically back to where it was before he made those policy announcements. You can probably largely thank the Bank of England for that. Yet Liz Truss still seems like she is not going to make a U-turn. She wants to stay firm in those policies. So my question to you is, what happens next?
Yeah, morning, Kaylee. And absolutely right that we haven't seen much signs of a policy U-turn from the government. Very much saying the plan for growth has considerable merit in terms of raising trend growth in the UK economy. An analysis I wouldn't necessarily disagree with. I think what is, if you like, reassuring markets, putting a floor under sterling, leading to a bit of a relief rally, is when you say what is coming next, there are signs that the government is listening to the reaction to what has been an institutional scorched earth policy over the course of the summer. They've sidelined their independent Office for Budget Responsibility, who do assessments, the costings of their package. Now they're bringing them back into the tent. They've slagged off the Bank of England, but the Bank of England got them out of a hole earlier in the week. There are signs here that they are listening, and they are doing what they probably should have done ahead of last Friday, which is get those independent institutions to give them air cover to their plan. They're doing it late, they're doing it after the event, but that is probably going to be a continuation over the next few weeks as they try and gradually rebuild credibility with the markets.
Okay, Simon, good morning to you. So,
Morning.
yeah, interesting to see them trying to build credibility with the market, and this meeting with the OBR today will be interesting. That takes us into next week, Conservative Party conference. A lot of Conservative MPs choosing not to go if they don't agree with the policies that have been announced recently. But the Prime Minister has to give a speech, and she usually, whoever the Prime Minister is, they usually like to play to the room. The more she tries to play to the room, the more she could upset the markets, would seem to be what we've learned from last Friday.
It's an unenviable trade-off that she's got to make in terms of providing some red meat to the faithful versus very mindful that not just UK markets, world markets will be looking at what she says in terms of substance. The more difficult backdrop that she has also is it's not just financial markets that are taking a pretty bad assessment. We've had opinion polls out in the UK of the last sort of 24, 48 hours that have suggested the ruling Conservatives are anything up to 33% behind the Labour Party, which would almost completely wipe out the Conservatives if it was replicated in a general election. Now, I don't think many political commentators would suggest that that is a likely outcome, but it certainly will be scaring some Conservative MPs, and they will be pushing the Prime Minister to try and sound a little bit more statesman-like, statesperson-like, and actually sound like they've understood the gravity of what this means, these moves in gilt markets, which can feel quite remote, what it means for UK businesses, households, in terms of their debt servicing costs, their mortgages, because there's a lot of fear out there.
Yes, because these gilt yields, they were rising very quickly. The Bank of England stepped in, but that was a temporary operation, they have told us. And now the Bank of England has to make a decision. So they put up interest rates in the way that maybe those who've been putting money into or those who were selling the the pound had been asking them to? Or do they not do that because they're fearful of tipping the housing market over? I mean, if you took yields up to 6%, what would that do to the housing market in the UK? Just for the international audience, the housing market is really crucial to the UK economy, and what, it can't handle rates as high as 6%?
Well, there's about £1.4 trillion worth of outstanding mortgage debt. That's about 70% of GDP. The good news, if you like, is that about 80% of that is on a fixed rate, and therefore that delays the moment of pain for a lot of households, but 20% is on variable rate, and they'll see an almost instantaneous pass-through. But you get about 1.2 million households. What is that? That's about 5% of households over the course of the next 12 months who will start to come off those rates. That gradual ratchet up, in a macro sense, will be gradual, but on a micro sense, will be very, very significant in terms of the disposable income of those households concerned. And I think that is the fear. It passes through to consumer confidence, and hence a risk of real precautionary saving and a slowdown in consumer demand.
Katie, jump in.
And Simon, from your perspective, what is the more dominant force in the UK economy right now? Is it fiscal policy or is it monetary policy?
Well, we have a fear of fiscal dominance. It's absolutely the right question to ask. So fiscal dominance is when the actions of the fiscal authority, in this case the Treasury, are making the ability of the monetary authority, the Bank of England, not to be able to do its job. It's constraining it. And I think we saw signs of that in the last couple of days. There is no doubt that the Bank of England's intervention on financial stability grounds to delay the start of quantitative tapering or active quantitative tapering in the UK was the right decision given the scale of the volatility. But we cannot get away from the fact that that is net at the margin. It is inflationary at a time the UK inflation is running at 10%. So fiscal policy is dominating monetary policy, and that is quite a difficult look, if I'm honest, at a time when you want to, if you like, elevate the idea that the Bank of England is an independent operator in terms of how it's dealing with the UK economy.
Well, and let's talk about the Bank of England's independence or insulation from other central banks. I mean, what's the bleed through from the Bank of England having to act in this way to the ECB or the Federal Reserve as they also are moving to tighten policy?
Well, it's the right question as well, because UK macro, let's be honest, it doesn't often get global attention. The UK economy is 2 to 3% of the global economy, and therefore the spillover, the contagion spillover of domestic policy decisions is generally quite limited. I've been, very vocal in my research, my commentary on saying that, in most markets, the UK is a price taker, not a price maker. But I think such is the scale of, if you like, market angst to what was a big expansion in the fiscal envelope in borrowing that, let's be honest, today has been largely replicated in Germany in terms of their energy market intervention. The fear will be that actually the UK not so much has made a policy mistake, but is the first mover of how financial markets may react more widely to big expansion in primary deficits to deal with what is a big exogenous shock in energy markets.
It certainly touched a nerve, didn't it, Simon? Simon French and Pam Muir-Gordon, thank you very much for joining us. Really good to speak to Simon ahead of that important Conservative Party conference next week. Now, coming up on this programme, we'll stick with the theme of energy markets and how that feeds into inflation and the broader global macro story. And Sophie Corbeau joins us, global research scholar at the Centre on Global Energy Policy at Columbia University. This is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in this space full time, I think it's very hard to run a successful crypto fund.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Katie Greifeld and Kayleigh Lyons over in New York. And Kayleigh, we've got European ministers meeting to try to resolve issues around the energy policy in Europe, to try and take some bold action. In amongst that, we're seeing national governments taking action. We've seen the German government, as Simon was just referencing, setting out their plan. They're very against the idea of a broad cap on the price of gas. They'll be meeting with the French leadership on Monday, we now understand. So that's the European story. I know this is obviously something that has been very political, has political implications in the United States, and clearly has political implications, as we've seen, in the UK over the past week.
Yeah, it absolutely does. And it's a question for me of whether you get some fractures within the allies who, in large part, have acted together during the ongoing war between Russia and Ukraine. They have managed to maintain kind of that coalition. And I just wonder, given the magnitude of this energy crisis and the degree to which it is affecting these economies and putting pressure domestically on these leaders, if their ability to agree is going to start to wither, Katie.
And you wrap that into the markets and you wonder what it means for a very stressed out global equity market picture. We know that in times of volatility, obviously correlations go to one. It feels like every global equity market is taking their cues from the UK at this moment.
Right, that's the sort of macro backdrop. Let's get into a conversation about where we go on energy markets. Anne-Sophie Corbeau joins us, global research scholar at Columbia University, and can shed some light on energy policy here. Good to speak to you, Anne-Sophie. There seems to be disagreement amongst European leaders around whether a cap on the price of gas would be a good thing or not. What's your view?
Absolutely. I mean, I think there has been an agreement on capping electricity prices, as announced by Mrs. van der Leyen in her State of the Union address on the 14th of September. However, they do not agree on how to cap gas prices, because gas prices are very much international. So one of the ideas is to cap the gas which is coming from Russia. But some people fear that then Russia is going to cut the remaining gas flows going to Europe. Another idea, because people have noticed that the TTF gas price, one of the major spot prices in Europe, is disconnected, or as Mrs. van der Leyen put it, has not adapted to the current situation. And there is indeed a very big disconnect between this price, the TTF price, and the imported LNG price. This is essentially due to the bottlenecks. So one of the ideas which has been announced is to maybe use this LNG price benchmark instead of the TTF. But this is also creating some issues because such indices are not as liquid as a TTF. And if you want to create another benchmark, it takes years. I mean, it has taken a decade for TTF to become as liquid, as transparent as we see today. Another idea has been, well, let's cap import prices in general, but then this is going to have unintended consequences, because if you are capping, for example, LNG prices, then the LNG is going to go somewhere else. And one of the major sources of gas to replace missing Russian gas has been LNG. So if Europe is no longer able to attract LNG, then Europe is going to have a serious gas problem.
Well, and it becomes a question not just of supply, but of demand. That is something that they all seem to have a bit more agreement on, the idea that you need to bring demand down. To what degree does that realistically need to happen with the energy resources Europe looks like it's going to have available?
It is absolutely necessary, and I would have hoped that the ministers would have realized that a little bit earlier than when Russian gas was really cut in June, and then they came up with this gas for a safe winter plan. I mean, the problem is that we are not getting enough gas. This is a fundamental supply problem. Now, Russian gas is done at 20% of what it was on average in 2021. So we need to do something in terms of demand. And there are essentially three big sectors. There is residential use, there is industry, and there is power generation. Right now, industrial gas use is really down. It's really down because industries are starting to cut output. Residential use, as you may have seen in Europe, there is a lot of pressure and advice to residential users to limit their consumption. A lot has to be done there. And finally, the use of gas in power generation has been increasing, mostly for two reasons. Nuclear and hydro are down year on year. Nuclear mostly because of the decommissioning of nuclear power plant in Germany and because of the French issues, and hydro because we have had not enough rain, not enough snow during winter, and also a heat wave during summer. So this has really put has had a very strong consequences and impact on hydro levels.
And Anne-Sophie, on the topic of these gas caps which are being discussed, we know that France and Spain are in support. We know that Germany opposes. And from your perspective, is there enough unity in Europe at this moment to implement these caps?
I think, it's particularly complicated to have unity because, some people fear that there will be unintended consequences with price caps. People always find, or companies always find a way to basically go around the price caps, and things that you thought were going to be okay and a good idea in general have then, some other consequences on the market. I think it is, an idea and a good idea to try to reduce the price. Well, electricity is definitely moving forward. Gas is looking very complicated. But, the problem is how do you do that in practice, and how do you ensure that there would not be other consequences that you had not anticipated?
Yes, we've already heard from Germany saying that they won't cap gas prices in Germany. They want to go a different route. They're going to be meeting with the French on Monday, no doubt, to talk about that, amongst other things. Anne-Sophie, thank you so much for joining us. Anne-Sophie Corbeau of Columbia University, thanks very much for your time this morning. Coming up in the next hour, UK Financial Secretary to the Treasury, Andrew Griffith, will be talking to the Bloomberg surveillance team. That's at 6 a.m. in New York, 11 a.m. in London. What can he add to what we already know about the UK's fiscal plans? This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Katie Greifeld in New York and Anna Edwards in London. Matt Miller is on assignment. Now let's take a look at what's ahead today. As we've already mentioned, EU energy ministers are meeting in Brussels on the power crisis. There will be a press conference from the Czech presidency and European Commission at 7:45 a.m. New York time. Russia will also sign treaties to absorb the 4 regions in eastern and southern Ukraine at a Kremlin ceremony at 8 a.m. Eastern. Putin will also make an address to legislators and other officials. We'll also be hearing from Fed speakers, including Fed Vice Chair Lael Brainerd and New York Fed President John Williams, plus a new show, Crypto IRL, hosted by our very own Katie Greifeld and Tim Stenovic, airs at 8 p.m. New York time on Bloomberg Quick Take and 8:30 p.m. on Bloomberg Television. Let's get a sneak peek.
I think the challenge with crypto is so many people in 2021 especially, we saw this in 2018 and before that in 2014, so many people view crypto and so many people online marketed crypto as a way to get rich quick. So people were marketing a lot of these things as an easy button, and as you and I and everyone knows, right, there is no easy button. And I think the challenge is that a lot of people had incentives to market certain things as safe, to encourage people to invest in certain things, and also people don't want to do their diligence. The point I'm making and what I'm trying to illustrate is this is not a phenomenon that's unique to crypto. It exists in all parts of the market.
Can I just say, to maybe defend the crypto industry a little bit more, think about the traditional currency industry. Forex scammers on Instagram, I just can't. Before basically crypto exploded in the way it did in the pandemic, some of my favorite accounts on Instagram were these like Forex scammers, like flexing like their Gucci's and their Ferraris.
On the private jet.
Yes, I love.
I think you make a good point, though.
Yes,
but you're not seeing those advertised in the Super Bowl.
No, but.
So it did reach a different level.
But are you saying?
Of the cultural zeitgeist.
Well, I mean, a Forex scammer is different from like Coinbase buying a Super Bowl ad.
Right.
Which, by the way, I love that Super Bowl ad.
Was that the QR code?
It was just the QR code bouncing around. I'm like, it's kind of a baller move to spend millions of dollars on a little bouncy QR code.
So it sounds like I mean, in your opinion, the industry does not have anything to apologize for. It's more like.
I think apologize is a challenging word. I think there are certain individuals who maybe behaved in a way that is not great, but I'm not a judge, I'm not a jury, I'm not an executioner. I do my best to not engage in that behavior. I never tell people invest in this, buy this, do this. So I can't speak for that. I'm not the moral compass of the industry.
Well, it's very generous. Thank you for that promo. But yeah, premieres tonight. We've been working on it for a long time, so tune in. As you can see, it's pretty casual, pretty fun.
Pretty casual. All I can say is I want a different backdrop. This is no good anymore. Katie, thanks very much for joining us. More surveillance follows. This is Bloomberg.
should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
Jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
I think it's very hard to make a bullish case right now.
We really don't know what's going to happen, but we also obviously see that there's a lot more vol in the markets.
As long as the dollar and yields continue to move upward, investors need to brace themselves for more pain.
Some of this volatility is really a reaction function to that problem that central banks are having.
It seems like central bankers are willing to push things as much as possible, but not at the risk of financial stability.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Congratulations, you made it to the end of the third quarter, and you have another 3 months to go. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures positive 0.7%. TK and Gage, get your head up. Let's go. Another messy quarter behind us.
It's a messy quarter. I saw Gideon Rose yesterday at lunch, John, the Acts of Foreign Affairs magazine. I said 2022 was his fault. And, John, I look where we are in this derivative story in the United Kingdom is absolutely front and center for global Wall Street. Focus. The Bloomberg Financial Conditions Index for the United Kingdom has not reversed. It's moving down this morning to new levels of restriction for the nation.
Lisa, we've got a lot of problems to deal with, not just for the UK, but for the global economy as well and for global markets. 3 straight quarters of negative returns on the S&P 500. I didn't realize this. You have to go all the way back to 2009 to see a streak that bad.
And you have to go back to forever to see a streak that bad when it comes to the bond losses. So the flip side is there's no place to hide, right? So stocks are selling off, and the nature of that sell-off is continuing to change. Just overnight, we got a number of earnings. We have had downward revisions of the earnings expectations by Wall Street analysts. They have not gone far enough. That was the message from earnings that we got last night. And going forward, the earnings are going to be front and focus.
Mr. Hartnett over at Bank of America, almost on the edge of constructive about 2023. I'm going to come back to that note in just a moment. I'm going to whip through the price action. Elisa's going to go through the day ahead in just a moment. Futures are positive by 0.7% on the S&P. On the NASDAQ 100 up 6 or 0.7% also. So can we get a strong finish to a pretty rough, messy, volatile third quarter? Yields lower by 9 basis points on a US 10-year, 369. Lisa, what a range we've seen in the global bond market this week.
How much has been driven by the United Kingdom and what happened with the budget that was proposed and the violent reaction in markets today? We do get perhaps some kind of fiscal response, and we have seen the pound really ratchet back some of the losses and regain some territory versus the dollar in expectation for possibly some change of tone. Prime Minister Liz Truss and Chancellor Kwasi Kwarteng are holding emergency talks with the head of the Office for Budget Responsibility responsibility. They had postponed the report from OBR, basically saying there were other aspects of the proposal they were not willing to release yet. Now, are they going to backtrack on this? Regardless, people are getting a little more optimistic that perhaps the worst case scenario will not pass with cable at 111. Meanwhile, today, August U.S. personal spending and income data is core PCE deflator. All this U.S. data, that is coming out at 8:30 a.m. and University of Michigan Sentiment Survey at 10 a.m. Core PCE deflator, this is the Fed's favorite metric to look at to get some sort of sense of the trajectory, especially at a time when this is the area that probably may be the stickiest going forward. Right now, we are expecting a little bit of a stasis there, but especially with the Eurozone, seeing 10% inflation for the first time. We just got those numbers this morning. It just sort of shows you how difficult of a problem, how intractable this is. And at 11:30 a.m., President Biden is delivering remarks on Hurricane Ian recovery efforts. It's been just devastation, John, and it's going to cause a huge recovery effort, the likes of which will probably cost somewhere between $69 and $100 billion.
Lisa, thank you. We're going to return to that in a moment. A little bit later this morning, we'll catch up with Anne-Marie Hordern. Tom, I wanted to start with a poll over in the UK from YouGov. Labour with a 33-point lead over the ruling Conservatives. This has been described by YouGov, Tom, as the biggest lead enjoyed by any party with any polling company since at least the late 1990s. That is big.
John, I took all the little itty-bitty parties out, and I took the Liberal Democrats over to Labor because I guess they're not conservative, and it's stunning the gap between Labor plus LDI and the Tories.
Unreal. Joining us now, Andrew Griffith, the UK Financial Secretary to the Treasury and the City Minister. Andrew, fantastic to catch up with you, sir. We understand the Chancellor, the Prime Minister, is meeting with the OBR today. The Bank of England's gilt market operation ends in the middle of October. Should those forecasts from the OBR be published before then?
Well, the key thing to take away is that the government, the OBR and the Bank of England are all working in a coordinated fashion, each doing their respective jobs. So the bank's doing its job on monetary policy and market conduct. The OBR, its job on forecasts and bringing forward the forecasts when they're ready to be able to wrap in the recently announced government growth plan. And then, of course, the government growth plan, which has features about energy, protecting households and businesses, how we're going to go forward on energy security, building clean energy going forward, and also a lot of supply side measures in the UK. It's a very growth orientated plan. So what you've seen over the last week is each of those players do their job. It's good that the Chancellor and the Prime Minister are joined up with the OBR. I think that meeting finishes shortly, but you've seen a lot of coordinated activity over the last week.
Andrew, I haven't seen coordinated action at all. I've seen a mess. I saw you come out last week with a mini budget, the Bank of England follow up with unprecedented intervention in the gilt market, and the OBR, now you visit the OBR and look for some forecasts after the fact. Why weren't these forecasts published alongside this mini budget last week?
Because the growth plan's got lots of components to it. There was an imperative to act this time last week. It's tomorrow. This is the quarter end. It's tomorrow that energy prices would have gone up across the United Kingdom. Real uncertainty for businesses and households. So it was right to do that then. There's a lot of detail in terms of how the UK government wants to see growth going forward. And that wouldn't have been available to the OBR to factor into their forecast. Indeed, some of that we're still waiting to announce over the coming weeks, plans for infrastructure, for the housing market, for childcare, some of the deep-seated challenges that probably all of our major economies have with growth. So, look, it's been a busy week, but each of those players are doing their job in a coordinated fashion.
How concerned are you about the increase in borrowing costs, with some people citing a 10.5% mortgage cost at a time when the Bank of England is being tasked with offsetting a proposal that has not been put out there, but the market is responding?
Yeah, look, of course, rising rates are a concern. We've seen that obviously, going into last week. I think you'd seen more tightening in the US. That's now happened in the UK as well. We've seen figures out of Europe as well today indicating that they've got exactly the same sort of issues around inflation. What the energy package measures do is actually reduce the headline rate of inflation, and that's something that's going the other way to the trend we're all seeing.
But Andrew, there is this discussion about not releasing the OBR report earlier than the November 23rd deadline at a time when the market's moving. It's having real-term effects now. Why not just release it earlier to give people a sense of what's going on?
Yeah, well, Lisa, look, I was a finance director for 11 years. You know, my board wanted me to release my figures as early as I could, but they also wanted them to be credible, to take the time to reflect all the information in a very fast-moving world that's available. So everyone will have their own view on that. I think you just have to recognize there is a balance between speed and velocity and being able to wrap in information. And some of that information, as I say, will be coming forward. The growth plan itself is a 40-page document, and some of that detail will still be released over the coming weeks.
Andrew, it's not for you to decide how long the OBR needs, is it? Let's get real about this. We're reporting now that you haven't sought to accelerate the watchdog's eco forecast at all. That's our latest report, according to officials familiar with the comments after the OBR Treasury meeting. Why haven't you asked them to accelerate it?
Well, I've talked about how there's a lot of different detail. I don't know how familiar you are with all of the growth plan. People have heard some of the headline measures. They've been widely reported, perhaps less so about the plan for infrastructure, the plan for immigration, housing. You know, these elements, really important elements of the growth plan, that is how we're going to finance the fiscal announcements that were made last Friday. So I think you've just got to look at it as a package. When the Chancellor asked the OBR to report on the 23rd of November, it was in contemplation of being able to take into account the whole of that package.
Have you asked the OBR? Have you asked the OBR to bring forward those forecasts as soon as possible, or have you told them that you want them at the end of November?
Well, the Chancellor will read out on his meeting in due course. But in the meantime, you know, don't lose sight of the fact that the fundamentals here were strong coming in. We started this with some of the lowest rates, the lowest debt to GDP in the G7. The economy is still growing, albeit we acknowledge that there's challenging headwinds.
Andrew, Tom Keene in New York. I'm sorry to bother you. As we speak, the Bloomberg Financial Conditions Index for the United Kingdom is a -4 standard deviations. You have seen a 7 standard deviation move in the blended gilt price move. You have a derivative disaster. You are the city minister. What are the regulators going to do finally to amend the derivative shell game that caused the Bank of England to bail out the marketing industry of LDI?
Yeah, and you'll be aware, Tom, about the independence of the regulator. So one of the things that you learn as city minister is that the regulators have their job to do. What my job is to make sure that we have the most competitive environment in which to do business.
Okay, you have a competitive environment that on a 7 standard deviation move blew up. Fine. What does the United Kingdom do off of the scandals of 2007 and 2008 to finally control the natural greed of the derivative business? You're at the heart of this as city minister. How do we finally get our every 8-year derivative blow up fixed?
Well, the Bank of England is taking the actions that they need to in the market right now. In the long term, of course, we look at getting the right regulatory structure, and that's a shared objective of ourselves and the bank and the prudential regulators. So, you know, of course, one will always look at wherever there are other points in the regulatory structure that need to be looked at. But that's not the focus for today. The bank's made its judgment and its interpretation of the markets. The thing to your point earlier, Tom, in terms of the politics, is that we need to communicate how this country is going to grow. That's what's going to give people the confidence to invest, the confidence to hold the currency, and the ability for us as government to fund the high quality services and all of the infrastructure that we need.
To Mr. Farrow's questions earlier, what do you need to do on this Friday evening to give confidence Monday that the different experts are advising the Truss government of the outcomes of their Reaganomics-like policy?
Well, I wouldn't accept that characterization. What you need to know and the markets need to understand is that we are working absolutely in lockstep. You've seen a number of coordinated announcements from both the government and the Governor of the Bank of England over the course of this week. I spend my time meeting investors, talking to regulators, talking to the financial markets, but these are volatile times. And we're seeing that in every market. Sometimes at different speeds and pace, but it's a macro trend that we're seeing. And some of the things that we are tasked to do is to bring forward supply side reforms to improve the UK's energy security situation, because the aberrant here is the strength of the US economy, the strength of the US dollar as a function of your greater energy security.
Wait, it's
so
our
we can't
fault.
fix that one overnight.
I just want to make this clear, John. I believe the minister just told us it's our fault the UK's blown up. I think that's what I heard.
Well, we don't have time.
No, that is not what you heard. What you heard is that we've got a job to do to try and improve our energy security. And if anyone thinks that this isn't ultimately a macro issue that flows in part from Putin's invasion of Ukraine.
Andrew, I've got seconds on the clock. If you can just wait there, we'll come back to you. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Navigating the economy toward a more sustainable path necessitates higher interest rates and a downshift in the pace of economic activity and the labor market. But for now, inducing a deep recession, the kind we had back in the 1980s, or some would even think of the Great Recession, that is not warranted.
That was Mary Daly, the San Francisco Fed president, speaking just yesterday. Live from New York City, this is Bloomberg. Moments ago, we caught up with Andrew Griffith, the UK Financial Secretary to the Treasury and City Minister. We bumped up against what is called in the TV business a hard break, a commercial break that was set to begin seconds away. And unfortunately, he couldn't complete his thoughts. The City Minister had to go, and hopefully we'll get him back soon.
John,
well, hopefully we can get him back soon and we can wrap up his thoughts, Tom, another time.
Your comments on this, John, were absolutely timely. And what I got there, John, was a complete lack of urgency of the moment. When I still see, I know pounds recovered, but there seems to be a complete understanding by the British government of the urgency here within global Wall Street.
What they're first trying to address, and what was clear from that interview, is they're trying to address the optics here. Come across as a united front, coordinated between them, the independent body that provides the forecast, and the Bank of England. That's not how it played out over the last week. Typically, if you had a budget announcement, alongside that budget announcement would be some independent forecasts from the Office of Budget Responsibility. That didn't happen this time around. Then what would happen, obviously, is that the Bank of England would meet November 3rd and they'd provide you with some new projections and monetary policy. Of course, that's not what happened either. There was nothing coordinated about this. It was messy. So what's happened is you got the budget, then you had the massive market fallout, an unprecedented gilt market intervention from the Bank of England, and only now is the Chancellor and the Prime Minister meeting with the OBR today. And it's still not clear to me when we actually get those forecasts. The OBR confirming just now they're preparing the forecast for November 23rd to go along with the fiscal statement. So, Lisa, here's the timeline now. October 14th, the gilt market operation ends. November 3rd, we have a Bank of England rate decision. Then all the way out onto November 23rd, we have a fiscal statement. That's a long runway, given how quickly this market's been moving.
Especially because the Bank of England has to respond, and that's what the market has told them. That's clear from their intervention this week. If they raise rates in the meantime, they cause real pain, they cause real changes in the spending habits of households at a time when all the details aren't out. Is that the policy that they had intended?
Futures right now up 0.8% on the S&P. Can we get a strong finish, Tom, to a messy third quarter?
A messy third quarter, and we'll continue this discussion on that shocking interview with the finance minister and the city minister of London. Chris Marenghi joins us right now. He's observing Britain. He's observing these crises from a prism of value, equity, investment. How's your study of the British economy going, Chris Marenghi? How do you pull this global Wall Street tumult, clearly what is a massive derivatives failure, how do you pull it over to conventional Gabelli investing?
Well, it's just about, we're certainly learning a lot more about LDI and how this all works. It's another micro input into another macro input into our micro forecasts for companies. We're overlaying currency moves and what that impact might be on revenue and costs for all of our companies.
Do equities in the United Kingdom enjoy the repricing and value that we see in gilts?
There are certainly some bargains throughout Europe. It's probably too early for us to do much there, but we're looking for companies that, in some cases, the UK companies that are selling abroad and are benefiting from their price competitiveness given the movement in the pound. One of those would be, for example, Diageo, which sells a product that is not going to go out of style anytime soon. You probably drank it last night. We'll drink it certainly tonight, and that looks like it's increasingly interesting.
As you watch the fast-moving picture internationally in the UK and in Europe as well as China, how much do you think has actually been factored into U.S. multinational companies and their earnings, not only from the strong dollar, but from the deterioration in the backdrop in some of these other regions where they export to?
Yeah, I don't think it's that. Obviously, this is not the first time we've seen these kind of movements, and they never seem to be fully priced in. We thought we'd see a lot more earnings weakness in the second quarter. That turned out not to be the case. The U.S. consumer in particular was more resilient than we thought. We're bracing for some pre-announcements and earnings cuts as we begin to report the third quarter in the next couple of weeks. So we'll see. Obviously, that's an important factor, along with the overall multiple, which we're still trying to determine for the market.
So everyone's pretty bearish right now. Are you a bull?
I would say I am a chasing bull. We think that listen, we've been through this before, 07, 08. I don't want to echo Larry Summers' view that this feels like 07, although there are some similarities. But I think if you held on through that period, we did quite well in the equity markets. We did well relative to other strategies. It's about finding the right business models, the right balance sheets, and the right managements to make it through to the other side, and that's what we try to continue to do every day.
Chris, great to catch up, as always, sir. Sorry it's on the short side. Chris Marangi there of Gabelli Funds on the equity market at the moment. Mr. Hartnett over at Bank of America, bearish all year, put out a note this morning that said the following: the big low's not until Q1, when the recession credit shocks equal peak Fed and peak yields and peak US dollar. The Trader 23. How's this for constructive for next year? Short the dollar, long EM, small cap and cyclicals. What do you make of that, Lisa, this morning from Bank of America and the team?
It makes sense. To be completely honest, it makes sense, because if you believe that things are moving as quickly as some of the earnings seem to suggest, as some of the peripheral data, that more sort of granular data seem to suggest, then if we get a pause, if we get some sort of downturn next year, you can start to expect and price forward the recovery, which might be what they're looking for. And I think other people are looking for this too, right? Mike Wilson was talking about where we are in the different economic cycles, the stock market as a forward-looking instrument. So we're looking forward to 2024, which potentially could be better than 2023.
John, here's a precursor, what Chris Marangi just brought up. He mentioned Diageo, the huge liquor complex of the United Kingdom. In sterling from a high, it's down 6%. In dollars from a high, it's down 23%. That shows the distortions we've got upcoming starting October 14th.
It's been a crazy time.
Yeah.
Before we even get to next month, we've got to reflect on the amount of intervention we had in the last couple of months. I would argue we started with the ECB, Lisa, earlier in the summer, when they were facing down the prospect of hiking interest rates and at the same time had to do something about containing bond yields. We're seeing that play out in the UK in a much bigger way this week. The BOJ's had to come in and intervene in the FX market. China's threatening to do the same. And I think we've got to almost restart and think about what this tightening cycle is going to look like. Does it involve QT? Will it actually involve QT?
Or perversely, will it involve quantitative easing?
Exactly.
Will it perversely actually lead to central banks buying bonds of certain denominations while trying to hike rates? The difference, and this I think has become the distinction over the past few weeks, we have shifted from tightening into pain, tightening into a weaker economic cycle, to trying to spend, to do fiscal spending in order to support households while also tightening to combat inflation. We see this in Germany with that 200 billion euro plan that they put out there for energy prices. This is the tension emerging into the fourth quarter, and it is a tough one.
And policies in conflict all over the place. That's been a theme of this program, that's for sure, so far this month. Futures bouncing back up 0.8% on the S&P. Yields are lower by almost 10 basis points. We were 3.4% earlier this week. We're at 369. This is Bloomberg.
policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What a quarter it's been. Live from New York City, good morning to you. Equity futures bouncing back by 0.9% on the S&P. Coming into Friday, we were poised for a third straight quarterly loss. For a streak that bad, you've got to go all the way back to 2009. Yes, it has been that long. In the bond market, yields all over the place. We've talked about the range this week, through 4% briefly, back down to 368. Yields lower today by 10 basis points, 368.42 on a US 10-year. And talk about ranges. Cable in the last week or so. We can put up a monthly chart, but I can tell you where we've been on the last week. 103.50 Monday morning, all-time low in the Asia session. Right now, 110.95, and a higher session today, 112.34. That is a major currency against the dollar. Tom, have you ever seen a range that wide in a single week? 103.50 out to 112.
And using my word for the weekend is febrile, and that's what I see here. John, what amazes me is how all the other data does not correlate with a quote-unquote pound sterling rebound is being reported by the financial media. Just in the last 10 minutes, granted, it's rolled over a little bit. I get that. But I'm looking at all the other data out there in the Bloomberg, and it does not correlate with crisis over for the minister that we just spoke to or for his prime minister.
We've got a Band-Aid on things right now.
That's well said.
Lisa,
That's
a Band-Aid.
Right. Yeah.
And Lisa, by the time we get to the middle of October, people are describing that moment as a cliff edge. We had the Bank of England come out earlier this week, announce a gilt market operation that is targeted and limited. It's limited in time to October the 14th, the middle of October. Then their next move on the monetary policy side is early November. And I just wonder what happens to happen between now and then.
And what does the threat to financial stability look like? Yes, we saw the issue with some of the long-dated investment plans for pensions and what happened there. But on a bigger scale, we haven't seen a buyer strike. Does a buyer strike start to reassert itself, particularly in the debt markets, as big nations try to finance fiscal spending through debt markets that are changed? This is a new dynamic.
I know you're thinking Germany out with a massive package in the last 24 hours. Tom, double-digit inflation in the Eurozone.
Yes, yeah, you know, it got buried yesterday.
Double digits.
You brought that up. That was at 8 o'clock yesterday. John, that got buried. And, I mean, culturally, that's just unimaginable.
It's happening. It's the reality of things.
In Germany, Christian Schulz joins us. He's Deputy Chief European Economist at Citigroup. Christian, completely out of your remit, but I got to ask, and particularly I have to ask before you and I read the financial stability volume from the International Monetary Fund, which will be published here in a matter of weeks. Does Citigroup feel that Europe has the financial derivatives risks of the United Kingdom and even what's being alluded to in the United States? When you've got Dutch schemes doing derivative strategies and even German schemes, is this a risk to Madame Lagarde that we will see a derivatives blow up on the continent?
Well, the European Systemic Risk Board yesterday issued for the first time in its existence, which admittedly isn't very long, it was created after the 2008-2009 crisis, but it, for the first time, issued a general warning. It is really general if you read it, but it's pretty clear that we are worried that there's pockets like just been identified in the UK and the LDIs, in various parts of financial markets and beyond in Europe, right? Especially, for instance, in energy derivatives markets, we know that there's issues, but also in bond markets, equity markets, everywhere. It clearly is a big risk. Volatility poses a major risk, and central banks have to be aware of that.
How does that change the prism for the ECB launching to their meeting the end of October?
I think the October meeting is fairly safe. I think the risk, because the ECB is going to hike interest rates, the question is whether they're going to go 50 or 75. Gradualism, I think, is back in fashion now. If you want to prevent major volatility, you better act gradually. So going for 100 basis points or talking about QT already, I think that becomes less likely. Reliability or a steady hand is more needed. But also big shifts in the dovish direction, I think, don't make much sense if governments come out and support the economy in a massive way. So I think 75 basis points is a good call for the October meeting.
Perhaps that's the short term, Christian, but how much are you ratcheting up your longer term inflation forecasts for Europe in general based on some of the spending that they're doing to support households now, which are going to kind of counteract potentially some of the inflation combating of the central banks?
Well, the funny thing is, in the short run, they will lower headline inflation, right? These price caps are going to reduce inflation perhaps by 2 percentage points in Germany or half a percentage points in the euro area as a whole. And in the UK, they're lobbing off, 5-6 percentage points off inflation with these price caps. But this is an illusion, right? Because what these things do is they increase the demand for energy and therefore increase wholesale prices. And somebody's eventually going to have to pay for that. You can't securitize all of this. It is going to lead to higher inflation down the line. So what we're heading for, I think, is lower peaks in inflation perhaps, or somewhat lower inflation next year, but higher inflation for longer, above target inflation for longer. And that indeed, as you rightly say, poses a challenge to central banks, a credibility challenge to central banks.
Well, just to put some numbers on it, to give a sense of the scope here, are you talking about, for example, 2.5% inflation in the euro region until 2025? Or are we talking about 4% inflation through 2030, right? There is a difference of magnitude when we talk about a stickiness here for a longer period of time.
Well, we're still heading for some kind of recession in Europe. That recession may now be somewhat milder if all this fiscal support comes in, but it may also be harder because of all the financial tightening that central banks are driving at the moment. I still think there is a prospect whereby underlying inflation, say core inflation, gets in 2024, 2025 back to target, and where the central bank can, in a controlled way, sit this out. They have to hike, but they don't have to hike massively beyond neutral. The risk is that inflation expectations de-anchor. That risk is effectively a little bit reduced by these price caps because they reduce spot inflation, and therefore, the risk that households adjust their inflation expectations to that and raise wage growth, for example. But that risk you cannot dismiss, and people will see, of course, that if they use more gas because of these caps, the wholesale prices will go up, and sooner or later they have to pay for that. So the question is, what is driving inflation expectations? Is it spot inflation, or is it a general sort of trickiness about institutional credibility, which I think is increasingly the risk?
Christian, you go to the heart of the matter brilliantly. And this is the difference between, I'm going to call it continental or Germanic economics timeline in the United States. You're suggesting banks, central banks, can amend out and wait 3 or 4 years with patience and with stable policy, where in a technocratic United States, they're trying to fix it in 2 meetings. Is the x-axis of the United States Central Bank flawed for you? Is Germany and ECB, are they doing it more correct?
I think the US has a more straightforward problem to resolve. I think there is excess demand, the economy is overheating, and the Fed has to regulate it down. Of course, the government could help them, but the Fed knows what it has to do even without the government. I think the ECB has the problem that they can't fix this problem on their own, or if they try to fix it on their own, they're going to make the problem worse. They need the support of governments. Governments are the ones that can raise supply or can help raise supply of energy and therefore lift supply overall and bring inflation down. And governments need some support for that. Governments need stable financing costs. They don't need low financing costs, but predictably stable financing costs. So in an ideal world, the central bank and the government would talk to each other. The governments would do things that support supply, not that boost demand into a supply crisis, and the central bank would move in a gradual, in a controlled fashion. I think neither Europe nor the Fed can solve the inflation problem in 2 meetings, but I think, my perspective, the US have a somewhat more straightforward trade-off to do.
Christian, I just wanted your thoughts finally on a call I heard from BNP Paribas in the last 24 hours on the ECB. They think that they can go another 100 basis points beyond what a lot of people are thinking about. They think the ECB can go to 3% on the deposit rate. Do you think that's achievable?
I think it is. I mean, what that would do, of course, would put the ECB in actual tightening mode. In an economy which is probably still 3 percentage points smaller than its pre-pandemic trend, and which is heading for a recession, significant recession, that feels like taking it a bit too far. But the more governments are now doing to prevent that recession, shelling out money to households, helping corporates, the more likely it is that the central bank will have to go that way in order to get medium-term inflation down. So I think the risks of, or the chances of something like this are growing, but I still expect a recession. I still expect a recession to stop the ECB before they get to 3%.
Well, they're not forecasting one, are they, just yet? Christian Schultz there of Citi. It's kind of ridiculous, Tom. I think a lot of people are laughing at the ECB's forecast right now. When you've got the Deutsche Bank CEO, and Lisa said this a few times already in the last few months, the Deutsche Bank CEO is going around talking about the depths of a recession, not the if. Not the when, but the depths of it.
I'm going to cut some major slack, John, to any PhD economist who's quote-unquote forecasting right now. I mean, we're moving in real time. You see the headlines here coming out from your United Kingdom, John. My question is, what does Prime Minister Truss do to get to Friday afternoon? I mean, I'm baffled with there's some sterling weakness. It's not through resistance, but...
Well, let's talk about this meeting, Tom, so we can go through those headlines. You've mentioned them. The UK government said it will work closely with the budget watchdog. Lisa, this is about optics right now, but I can tell you this is a pretty unusual meeting a week after a budget, a mini-budget, a fiscal event, whatever you want to call it. Typically, you'd come out with those things and you'd get the OBR to come out with some forecasts alongside it, and it wasn't sequenced that way at all.
No, and it even wasn't sequenced for them to have all of the information in hand to come up with this projection at a time when the markets are pretty uneasy about this proposal.
Stupid question. Is OBR the same as the Congressional Budget Office?
I wouldn't know, Tom. I can tell you what it is. It's the Office of Budget Responsibility. It's an independent body that provides forecasts for the government to go alongside their forecasts. Is that the same thing?
Yeah, I think so.
There we go.
I think it's pretty
Then it's the same thing.
Yeah.
We're matching UK and US knowledge together. Beautiful.
It's just amazing.
I know. That's what the show's about.
Watch sterling.
Futures up 0.8%, 368. 368, 350 on S&P 500 futures. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Hurricane Ian's winds have picked up speed, and the storm's on a path to hit South Carolina. The forecast calls for Ian to come ashore north of Charleston today with heavy rain and a potentially deadly storm surge. Florida is struggling to recover after Ian made landfall as one of the strongest hurricanes ever in the U.S. Entire communities were wiped out and homes were flooded on both coasts of the state. An exact death toll has not been confirmed. In the UK, Prime Minister Liz Truss is under pressure to cut spending to win back the confidence of investors. Bloomberg Economics projects the cuts may even need to exceed George Osborne's infamous austerity drive of 2010 to stabilize public finances. Markets have tumbled since the Truss government unveiled unfunded tax cuts last week. Well, now there's more pressure on the European Central Bank to keep raising interest rates aggressively. The Eurozone has just recorded its first ever reading of double-digit inflation. Consumer prices rose 10% in September from a year ago, and that's the fifth straight month the inflation figure has exceeded the consensus estimate. Shares of Nike, they're lower today. The sports shoe giant reported that inventory has surged, and it's also had to push through discounts that have hurt profitability. Now, higher freight costs, markdowns, and foreign exchange effects hurt Nike's gross margin in the latest quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
What we're focusing on is delivering the growth plan and making sure, with things like our energy intervention, that people right across this country are protected. And without growth, you're not going to get the public services. We're not going to generate the income and the tax revenue to pay for the public services that we want to see. And that's why the mini budget was absolutely essential.
Kwasi Kwarteng there, the UK Chancellor of the Exchequer, live from New York this morning. Good morning. Equities shaping up as follows, up 0.6% on the S&P, on the Nasdaq 100, up by 0.5%. A little bounce after a pretty rough ride through much of the third quarter. Yields coming back in by 10 basis points, 368.22. I can tell you we were paused for another weekly advance in 10-year yields in America. Tom, let's see if we trim some of that advance through the rest of the session.
John, I would suggest, and this goes to the real yield this afternoon, this Friday is going to be hugely eventful based on some of the dynamics I see right now.
Bramo's guest hosting. I'm going home early.
That.
She doesn't know that
I didn't know that either.
Just let her know.
Oh, you didn't know that either, Lisa?
Don't worry.
You're like booking me on air.
Bramo's like, I am not hosting that.
Ooh, well, I've got to go look at this guy.
I got to go.
A little Friday.
Busy doing a victory lap into the weekend, Tom. Victory lap, just, the Bears, everyone's on board.
And John, I want to say thank you to everybody listening and watching worldwide who heard John Farrow's questions to the minister here 20 minutes ago. John, the basic idea is Global Wall Street's saying that was a public service. I mean, John, this goes back to our Rudy Giuliani interview of, I'm going to say, 2 years ago. That was outrageous.
Tom, I think what we need to sort out is there is a difference between policy and approach. You can have a debate about the policy that's come out of the United Kingdom in the last week, and it may or may not turn out the right way. It's the approach to this that I think we need to have a bigger conversation. There is a reason why these institutions are shaped the way they are shaped. There is a reason why there is a sequence of events that is meant to take place. It's to avoid stuff like this. So yes, the UK government wants to come out this morning and try and reshape the optics, that we're all on the same page by constructing that meeting with the OBR, by saying we respect the independence of the Bank of England, all of those things. That wasn't how the conversation went in the lead up to that mini budget. And that's certainly not how things have played out in the last week.
Well, it is sport to say the least. And what we do know is from the moment it was known that Jane Foley of Rabobank would speak with us, pound has weakened from 112 to a 110 handle as well. Jane Foley, I rarely do this, but I've got to get exceptionally narrow here, right down to the GIP function and some of the technicals on sterling. Give us your key support and key resistance levels for cable.
Well, we're seeing huge ranges right now, so that's really difficult to do, but we are targeting 104. Certainly cable remains really very vulnerable, because you've got to ask the question, well, what happens when the Bank of England takes away this extraordinary support of the gilt market? You know, the crux of the problem is still there, which is, what is this government going to do in terms of its fiscal policies? Now, it's one thing during the pandemic to issue more debt when you had the Bank of England hoovering up some of that debt through quantitative easing, but to try and do that when the central bank has reversed course, it's clearly very difficult to do. Now, the central bank again is going through its quantitative easing program, but that is a credibility issue. Is it supporting the government's fiscal stance?
Jane, explain to us the efficacy of foreign exchange analysis right now. When I look at fancy ratioed financial conditions indexes and fixed income spreads that are grim, does foreign exchange really tell me what's going on?
I think it does. I think sterling has been saying all year that UK fundamentals are grim. Sterling has been a poor performer all year. The Bank of England has been failing to turn sterling around with interest rate hikes, and that's certainly been the case since the spring. And that tells you that investors don't like what they see, and they don't like what they see even more because of the budget last week. And you know, even if you know some of those measures were to be reversed, and there's no sign at all that the government wants to do that, there is still being a dirty stain now on the credibility perhaps of the Bank of England, but certainly the credibility of this government. And you know, the government's talking about the necessity of this budget because it wanted to improve growth. Well, actually, you know, for many people, a lot of those subsidies on the energy price is going to be taken away in the form of higher mortgage payments anyway. People are going to be poorer as a consequence of this, and also maybe because of the way gilts look in their pension portfolios. So no wonder we've got the latest opinion polls saying that Labour has got a 33-point lead over the Tories at this point.
The United Kingdom has a unique circumstance in some ways, but in others not so much. And we are seeing fiscal spending around the Euro region to try to grapple with what is going to be a difficult winter. How much does this just accelerate the dollar dominance at a time when the U.S. faces a different picture, isn't necessarily engaged in the same kind of fiscal band-aid for a problem that has a longer lasting kind of time frame?
I think it does accelerate the outlook for the dollar. I mean, like you said, the market was already worried about global growth. It was already worried about UK fundamentals, which of course is why the timing of this budget was so bad. The Chancellor failing to read those market conditions. But it does accelerate the movement into safe haven for the dollar. But you know, I would really like to state that I don't think that US fundamentals operate on the dollar in the same way that fundamentals of say the UK operate on sterling. And this is because the dollar has its own set of fundamentals. It is a huge invoicing currency. It is a massive reserve currency because it's a huge invoicing currency. And the long and the short of it, the simplicity of it, is that when there is crisis, when there is uncertainty, people just need dollars. They need it to cover their liabilities, to pay their invoices, perhaps to cover their dollar debt liabilities, depending on where you are. So the dollar operates to its own set of fundamentals, which are really quite distinct from the fundamentals of the US.
Jane Foley, Jane, just wonderful to catch up with you in London and then back here in New York as well. Jane Foley, thank you, of Rabobank. It's a difficult moment for global markets, and I think there's going to be a massive struggle to normalise. And not just normalise pushing interest rates higher, but also normalise the balance sheets as well. This week for me, for you, Lisa, for you, Tom, I think has been a big week to rethink what is achievable with these balance sheets at the Federal Reserve, at the ECB, at the Bank of England. The ECB, they started this They told you almost immediately, yes, we're going to hike interest rates, Tom, but we're going to have to do something if yields spike too much on the periphery. Seen this play out in the UK, unique circumstances, I know. And I just wonder, Tom, how long before the Fed has to reconsider its balance sheet unwind as well?
I 100% agree with you, John. I've been watching this and I see it off real yield, which granted is given back a little bit this week. But John, what I would say for certain on this Friday is every single general counsel of every defined benefit program on the continent and across the United States is reviewing their liability-driven strategy if they have one. And people like Simon Wolfson, Lord Wolfson of Next, is taking a massive victory lap because they had the courage to say, no, we're not going to do that.
It's exposed a real vulnerability this week, that's for sure. Yeah. And the Band-Aid the Bank of England has produced expires in the middle of October. Let's see if it does expire in the middle of October, exactly. and let's see if they move to gilt sales and how quickly. Futures right now up 0.5% on the S&P. Binky Charter, Binky, where have you been? He's going to join us in just a moment from Deutsche Bank. Looking forward to that. Live from New York with futures up 0.5%, yields lower by 9 or 10 basis points. 368.62. Euro dollar negative 0.6%, 97.59, and crude 81.44. What was it the Russell Crowe said? Bremo, are you not entertained?
You're talking about the markets?
That famous line from Gladiator, are you not entertained? What a third quarter in this market. Yeah. Just absolutely. You've never seen Gladiator, Tom?
Never seen Gladiator.
Okay, we've got to fix that. From New York, this is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
It's such an interesting new world. The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
If you're not really in that space full time, I think it's very hard to run a successful crypto fund.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think it's very hard to make a bullish case right now.
We really don't know what's going to happen, but we also obviously see that there's a lot more vol in the markets.
As long as the dollar and yields continue to move upward, investors need to brace themselves for more pain.
Some of this volatility is really a reaction function to that problem that central banks are having.
It seems like central bankers are willing to push things as much as possible, but not at the risk of financial stability.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I'm proposing a 4-day trading week. With all the volatility, it should go down to 4 from 5. And then if the volatility calms, Lisa, then you get to, go back to 5. That's how it should work, based on how much people work.
It's going to always be a little volatile, just
of course.
So then you can always just take a 4-day work week.
Live from New York City this morning. Good morning, good morning. Bramo looking for a 4-day week. Futures positive, a half of 1% on the S&P. I'm on board too. Just doing your work. NASDAQ up by a half of 1%. TK on the quarter. Brutal, just brutal. Up and down, up and down, up and down, and heading for another quarterly loss.
The immediate now is so tangible, John, including our conversation with the minister early. I'm hardly focused on end of quarter, and you're absolutely right. It does matter with the VIX 31.29. John, I just looked at sterling, which in the last hour has given way. Full disclosure, it wasn't Jane Foley's fault, John. And I got a resistance of 1.1481. We're nowhere near that. And there's no support, technically.
110.69.
There isn't.
It's a breakdown, and this comes down to how quickly we'll get the forecast from the Office of Budget Responsibility, Tom.
I mean, if I had to go to Binky Chada, I'm like 25 years old and I'm shaking going in front of Chada. I'm like, the charts tell me I don't know where I am.
Binky's going to join us
right now.
very, very shortly. And Lisa, with Binky, we need to talk about some of these big tech names. Yesterday, B of A downgraded Apple. Apple got really hammered, slapped around, just on this idea that consumer spending is going to be a tough story worldwide. Facebook, Mark Zuckerberg, out with freezes to hiring, not layoffs, but a hiring freeze. And I guess you can't freeze what you can't sack what you can't hire.
And he basically is saying that Meta or Facebook is going to be a smaller company in 2023 than it is today. All of these cuts, et cetera, come as you get the semiconductor space flat on its back, coming out. Micron yesterday coming out, downgrading its expectation even further than people had expected. Taking a step back, at what point do the biggest names see this kind of loss? And then that triggers something. That triggers some financial risk, some financial stability issue that we saw, yes, in the United Kingdom. But as Larry Summers said, these are the preconditions for just that type of event here.
It's been very messy this week, that's for sure. It could be a stronger finish. Let's go through it. Futures positive, a half of 1% on the S&P. On the Nasdaq 100, up 0.4%. Yield lower by 9 basis points on a 10-year, 3.69. Euro dollar 97.65. We're negative a half of 1% on euro dollar at the moment. Tom talked about sterling weaker. Dollar stronger through all of G10, basically, Lisa, with the exception maybe of the Japanese yen.
Yeah, and it was because possibly the intervention that we've been hearing about in terms of how they are trying to support that currency. Jane Foley on just moments ago saying that she doesn't really see what could stop the dollar rally. A lot of people are in agreement. Today, we did get some sense of how long that meeting was with Prime Minister Liz Truss, Chancellor Kwasi Kwarteng, and the head of the Office for Budget Responsibility. We're hearing reports that, as Tom said, it was 48 minutes long. We now are waiting to hear what emerged from that. Are they bringing forward the timeline? This matters. It matters for what we're looking at in the pound. It matters for how much the Bank of England is going to have to raise rates. And it matters for people who are having to refinance their mortgages at rates or even just deal with raising rates at a time when, according to one report, they're hearing reports of 10.5% mortgage rates being cited. Today, we get August U.S. personal spending, income data, core PCE deflator, all at 8:30 a.m., followed by the University of Michigan sentiment survey at 10 a.m. I remember for a fleeting second that Fridays were University of Michigan sentiment Fridays that lasted all of a week. And now we are looking at the core PCE deflator. We take a look at how quickly some of that base effect is really taking effect and how much the Fed can look at this for a bit of reprieve. This is their favorite metric. Do we see some sort of roll-off in how high inflation is? And at 11:30 a.m., President Biden is delivering remarks on Hurricane Ian and the potential recovery there. John, I was reading one estimate that said that the recovery costs in Florida will be an estimated $69 to $100 billion. It will change the coastline forever. This is the third most populous state in the United States. It is an area that has seen a huge amount of people migrating there during the pandemic, post-pandemic. It is actually a disaster zone in many areas right now.
It's deeply upsetting for a lot of people. And Lisa, thank you so much for staying on top of the story. We'll continue to bring you updates through the next couple of hours, all day in fact, on Bloomberg TV and on Bloomberg Radio. Turning back to the markets, Binky Chadha joins us, Chief Global Strategist, Head of Asset Allocation at Deutsche Bank. Binky, you still at 47.50 year-end on the S&P?
I'm not still at 47.50, but yes, that is what I'm looking for at year-end, yeah.
47.50, how do we get there, Binky, in 3 months?
I mean, the basic thesis is, you know, I would completely agree, given where we are basically in the cycle. There's really no case for equities based on either earnings or the valuation of those earnings. But I think, you know, what one should keep in mind is what we've seen basically over the course of the year is the Fed, you know, providing guidance basically to a full rate hiking cycle, which is basically, in my view, given that 4 out of 5 of them ended in recessions, it's really, you know, forward guidance to a recession. So what we have is a situation where basically growth has been slowing, but with the Fed's guidance, you know, equity positioning has been falling much faster basically than growth has been slowing. I would say if you look and break up our positioning measures into sort of 2 parts, you know, one that's basically tied and based on what's happening from an economic fundamental point of view and earnings, you know, what you see is discretionary equity investors are positioned right now for 46, 47 in the ISM, manufacturing. What we've got the last 3 months is basically 53. So, you know, there's potential for a squeeze, but I would argue, you know, the much bigger potential for a pretty big squeeze really would come from the systematic strategies. I would say if you look at
they're going to step in and up we go.
It's a question of basically, you know, systematic strategies positioning at the end of the day is best explained by equity vol, and equity vol is just very elevated.
I got two ways to go here, Binky, off of John's question, and I've got to go to the one that matters. Luzetti came out at Deutsche Bank and said recession before anyone else. I know you respect Folkers, Landau, and Luzetti. They're getting it done. They've been phenomenal. But are you suggesting at the heart of your bullish call is this Fed blinks?
No, I wouldn't say that. I would just say, you know, yes, we are looking for a recession, you know, sometime next year. The question is, you know, exactly when, and is it going to happen here and now, given where, you know, equity market positioning is? What, you know, I'm calling for is, you know, bear market rally number 5, and it's likely to be bigger than number 4 is all I'm saying. Bear markets have plenty of rallies, on average 3 off of new lows, you know, going 10% or more. The 2 recessions prior to the pandemic, we saw, you know, on average, basically 5 bear market rallies of 15%. I would argue at this stage in the cycle, you just have to be tactical, you know, because we have this cloud of basically recession.
So, Binky, I remember a couple months back, you put out a forecast where you said if we get a recession and a hard landing, you could see, I forgot whether it was a 3,000 or 3,200 handle on the S&P, or on the high end, closer to this 47.50 or even to the 5,000s. It seems like the worst case scenario is kind of unfolding according to a lot of people, and many more people are pricing in a hard landing. What makes you stick with the higher end range?
So it's not really the higher end range. It's sort of an if then else and what happens when, basically. I would argue, you know, coming through basically the middle of the summer, you know, it seemed to us actually that recession was probably more imminent than happening next year. I mean, if you look at, you know, so it also depends on what you sort of think or believe a recession is. I think a recession is really basically about corporate risk aversion. And if you looked at, you know, simple measures of CEO confidence, you would see that in the middle of the summer, we were basically, you know, some of them were actually below the lows at the time of the pandemic, which is, you know, all the way down there. And so, you know, really primed for corporate risk aversion. When we got basically the commentary on Q2 earnings, though, I would say,